We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted earlier last week. It's going to be chopped up and released in a couple different pieces because our conversation ended up going just over 5 hours. We had the conversation on Friday, April 8th. If you'd like to be a part of the next one that we're going to be holding on Tuesday, April 19th at 7 p.m. Eastern Time, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app because then you can actually log in and ask us questions and interact with us as well. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, and anywhere you want to listen to it, as well as Odysee if you don't enjoy using YouTube. We were joined in this call by Bob Coleman, Tom Luongo, David Morgan, the Happy Hawaiian, and even Steve Penny for a little bit. I hope you enjoy it and hope to see you on the next one.
Mm-hmm. We have the silver chartist Steve Penny joining us. Steve had a question, and I'd like to get be able to address that and get some more questions going here.
Sure.
Steve, are you there?
Yeah. Hey, Tom, and Bob. Can you guys hear me okay?
Yeah. Sounds great.
Okay, cool. Yeah, fantastic conversation, guys. I've been sitting here just working, listening, and taking it all in. My question was for Bob. Bob, I know you're an expert in the space. I get questions about kinesis and some of these tokenized, silver and gold coins. And, I've got my answer. But I'm curious if you could maybe share your thoughts on that again. And unless you already addressed it, I missed the beginning of the conversation. And I listened to Jim Forsyth's conversation with Tom a couple weeks ago on Palisade, and I thought he brought up some good points. And before I share my thoughts, if anyone wants to hear that, I'm just curious if you could address kinesis and things like load and what your thoughts are for people who are maybe new, looking just to get exposure to physical silver and gold.
Yeah, I mean, it's a great question. I did a little bit of a show with Tom last year on, I think it was kinesis and one gold. When you look at the way I look at those products, it's like a checking account. It's you put in money that you could afford to lose because there is counterparty risk. There is, if you read the agreements, they're pretty one-sided to the sponsor's point of view. Kinesis is one that a lot of people like. It's very popular, but if you look at the limits of liability clauses that Kinesis has, it's one of the most stringent I've ever seen in my life. I mean, even if you could penetrate line one, which is they basically they don't have any limit of liability. Line two is you can only sue them or take them to court, I guess, in the country of Liechtenstein or the Cayman Islands. And even if you can win that, then your maximum amount is $10,000. I mean, it's these programs. I mean, they're designed for convenience. You just want to look at it.
You're muffled.
Oh, sorry. You just want to look at these programs kind of like. It's money that it is like a checking account, something that you don't put a lot of money into. Like one gold, that's a balance sheet financing operation. What you're doing is you're buying into a program. They can use that money to buy 1,000-ounce bars, for example, and use that to convert into 1-ounce rounds and go out and buy more 1,000-ounce bars. And that's the type of power that these programs have, and they don't market it themselves that way. But that's what they are if you read the agreements. And so that's what I get into. It's a little bit, rolling up the sleeves. And, I don't always I get sort of looked at as, hey, listen, you're not with us. You're not really a metals guy. You're for the industry, or you're for to me, physical metal has its place. I learned this from, I started following David Morgan back in 2003. Physical metal should be your core portfolio. Yep. Once you have enough of that, then you can branch out to mining stocks and trade the markets and, do these digital programs. But you have to understand the digital programs have counterparty risk to them. And that takes you into, like other vehicles like closed-end funds. And, people look at the ETFs and they try and interpolate, well, God, if I'm going to own gold, I'll do it through miners, or I'll do it through, these other products. And it's important to understand, I get a lot of flack with this, but PSLV, which is one that a lot of people like, and it's a great trading vehicle. It's low cost to get in, low cost to get out. I totally understand it. It makes a lot of sense. But when you look at the structure of it, it actually is very dilutive by nature when they do these at the market offerings, because if you really look at the fund, it trades chronically at a discount to NAV. And when they were doing their at the market offerings, a lot of that was done when it was at a discount to NAV. But the way they get around they use the regulations to their advantage, and the way they get around this chronic discount is they only need the market price to be above yesterday's closing NAV price. So if the silver price goes up, say that the NAV is at $9 and the price of the fund's at $9, but NAV is at $9.30. Silver goes up 35 cents an ounce the next day, for example. The fund goes up to $9.35. They can sell more shares into the market because those shares are priced above the prior day's NAV, even though the real-time NAV is $9.60 an ounce or $9.60 a unit. And most people don't understand that. And I've explained this to hedge funds. I explained it to professionals in the industry, and they're like, "Wow!" I did an article, and this article I was going to put out, but it ended up being like 11 pages long to try and basically explain what I just said to you. But it's these types of things that that clients don't really see, and they don't understand this sort of background dilution that takes place on whatever the investment may be. I mean, I run a hedge fund. I mean, the hedge fund I manage, it has a management fee like most other funds. And so there's a carrying cost with that. People just need to understand, how these digital programs are set up. A lot of times the tokens are an independent entity, or you own the token and not really the metal. And the program infers that you own the metal, but in reality, it's the token. Whoever holds the token has the metal, or has access to the metal. I mean, it's just, so yeah. So, I mean, it's a great question. I guess I'm more of a purist at heart, but to me, it's, these are, for people that are trading, these paper programs and digital programs are probably, they're an easy in, easy out type of thing. That the trading costs are certainly a lot lower than trading physical metal. But it's, just have that in the back of your mind.
Yeah, sure. I guess I think about like the new person, and my point to new members when I get asked this is, don't conflate PSLV as a substitute for physical metal outside of the banking system. And the same for these tokens. There's nothing wrong with them. They're just tools in our toolkit, and they could have a place as long as you understand what you're doing. But I see a lot of newer people thinking they own metal. That's, that's not the same thing as owning physical metal that you can put your hands on. So anyway, I appreciate the answer, Bob. That was awesome. I'll go ahead and sign off, Tom, but thank you so much.
Thank you, Steve. I think a great way to kind of summarize the idea of these tokens from my understanding, and not to kind of, point any finger one way or the other. When we think about the role of physical gold and silver, those programs have not been really pressure tested in a real crisis situation to me. The role of the physical gold and silver isn't necessarily as a real vehicle of capital appreciation, as more of capital preservation in some ways. It's not like you're going to get rich, selling or buying a couple ounces of gold and holding it for 2 months, while you have the price exposure that some of these digital programs tend to give you, right, Bob?
Yeah, no, you said it best. I mean, it's all risk analysis. I guess you could look at it. It may be, these programs may be the greatest thing in the world. I mean, they may be. It's a very convenient way to transfer wealth or to make a payment. I totally understand it, and as long as things are okay, the system rolls around just fine, and everything moves like clockwork. The problem you run into with any of these programs is the sponsor may be the one. For example, with Kinesis, from what I understand after reading, I don't know if they've changed the agreement since I read it, but one of the things that just worried me a little bit was that the sponsor is also the one that's on the storage, the master agreement with the storage providers. So, in essence, they could be doing leasing, they could be doing other things with metal that not nefarious, just doing normal trading practices and things like that. That ultimately may have the metal at risk at certain periods of time. It may be very quaint, but the opportunity is there because of the way the structure was developed. Other programs try to separate that structure. It just depends. It's not to say anything bad about one company or the other. It's just those are things that people have to look at and read the agreement with, so they can understand if something does go wrong. If lease rates go through the roof, for example, and a program is like an unallocated program like Perth Mint, where they're leasing metal out of the vault and basically running a business. If they have problems getting that metal back, or the cost of getting that metal back goes through the roof, that's going to impact the program, and that could have liability to the end client. But that's why owning metal in physical form, whether you hold it at your house or in a professional environment, you want to make sure how you store it at a professional environment. You want segregated storage versus allocated, and we can get into the allocated, segregated, unallocated differences, but everything has risk, and it's just a matter of how much risk you're willing to take. Just like when you trade stocks, I mean, you use technical analysis, you use stop losses, or you use tools to get you in or out of a trade. It's a very similar concept with getting into these programs.
Yeah, absolutely. We have David Morgan joining us as well. He was invited to the call and he had a prior engagement, but he's able to make it now. Guys, why don't we get to some of the listeners' questions here? I know we wanted to make this a bit more interactive, so if anybody wants to jump in and ask a question, let's try to get to some of those.
Tom, if I might go ahead and jump in here.
Go ahead, David.
I just listened to part of it. Good to have you both here, and Steve as well. Yeah, I think you said it best that, the digitized metal, crypto metal, blockchain-based metal, whatever you want to call it, is a tool in the toolkit. There are advantages, and here's a couple of them. One is that one of the problems in any time frame was walking around with, gold and silver in your pocket. I mean, that's true value. It's fungible. It's known anywhere. So, it's, robbery is an issue. Is it a big issue? No, of course not. But still, it's a concern. So if it's on a platform like a blockchain, you can make a transfer, and it's basically a bookkeeping entry, which is basically how all the paper markets run. The other thing is there's nothing like the real thing, and I certainly advocate that and always have. I mean, when it gets down to real crunch time and you got an open-air flea market in order to buy vegetables and clothing, like happens in Argentina every 10 years, you got a piece of silver jewelry, a gold ring, necklace, a coin, you got a very high-value barter item that's accepted almost everywhere. And that's not true with a digital-based currency. It could be, but the real thing, as I said, nothing beats the real thing. So I think it's good to have them both. What I do like about it is that it's very divisible when you have it on a electronic platform. You can go down to grains in gold and grams in silver in some of the programs, and that's a good thing. The other part is speed and cost. I've said this on many interviews, but I had one of my clients in the UK was trying to wire me money, and the bank was giving him a lot of pushback, and he's on the AUX program that I'm on, and I had him pay me, and 3 seconds later we're both happy. And he'd taken 3 trips to the bank to try to get this wire through. So there are some advantage, but again, that would be like the third or fourth thing I'd put on my plate. I'd have physical first, physical silver, physical gold. PGMs, that's a different case. I have platinum. I've sold my palladium, and the next one up could be, I think, mining shares, but not just sticking in the physical realm. Futures and options would be last. I think the next one up would probably be storing some in a different location than your home. I think it's okay. I have some at my home, but I don't have it all there because I don't want my life savings to be in one place. I advocate for higher net worth individuals, or even if you're modest, it doesn't hurt to have some with your parents and some with you, or some with your kids and some with you, or that type of thing. I just think it's prudent to put it in 2 or 3 places rather than have it in one location. And then having a digital platform and only using it as required. I mean, you get a big score on something, you could, throw some silver in there and, run your groceries through it. I mean, the one that I'm involved with is going to have a plastic debit card, hopefully by the end of July, August. Right now, there is a virtual debit card I've used many times. I use it for payment on the electronic platforms like Amazon. It's just 16 numbers with an expiration date and a CZV code, and I put those numbers in, and Bob's your uncle. I got my product, but I couldn't take that virtual card and buy gas with it. So I'm done there, Tom. I'll give it back to you.
Thanks for that, David. Let's take some questions here. Does anybody, Andrea, or I can't say Andreas? Sorry about that. Yeah. What's your question?
Oh, hey, thanks. I guess this is for Bob.
Give me 1 sec there, Andreas.
David, precious metals.
David, could you just mute your mic, please? Thank you. Go ahead, Andreas.
Oh, yeah, for precious metal. I guess this is for Bob. So for physical, I know I've been on Space with Bob before, and he stores it. I do like silver, but are there other more metals that are less like volume that he thinks in the future will do better? For example, like rhodium. I mean, I know catalytic converters and all this stuff, but do you think are there other ones that better bang for the buck versus the commercialized silver gold investments? That's it.
Yeah, that's a good question. Platinum is one that's starting to get people's attention, and it's not necessarily because of the catalytic converter situation. It's more on the hydrogen situation being used as part of that process in hydrogen vehicles. And then also, I think from what I've read, automobile manufacturers are maybe looking to swap back into platinum and out of palladium because of the cost structure. But it's interesting because this week you saw a little bit of a run on physical platinum products where some of the wholesalers all of a sudden got they kind of ran short or ran out of product very quickly. I think because the price dropped down to like $950 or something like that, and you just had a rush of people buying it. The problem with platinum, though, is most of the product is made by refiners over in Europe. So some of this you could potentially get supply issues with just because of the war in Ukraine, or if obviously you have any disruptions over there in Europe, that could affect just the supply of platinum products. So basically, premiums I think went up like $5 an ounce. I think on the wholesale level this past week. But that's a small market too, and David could actually probably address this in a lot greater detail.
Well, I'll jump in on this. Well, Andreas, what I'll say is it all depends on what you're looking for. I mean, are you looking for a speculative bet? If it's a spec bet that you're looking for, then why would you want to buy the metals per se? I mean, like this is where you'd be looking for, an investment on the production side or just, a fund of something like that. It's like, asking about, you're not going to buy yellow cake and stick it in your house. It's the same kind of thing. It's industrial metal. I don't know. To me, it's like, we're at a time now where we should be thinking gold and silver or really gold is the main mechanism by which to protect wealth, as Tom pointed out earlier. That it's not about speculation per se. It's about preserving your wealth in a time of crisis. To Bob's point, absolutely, all of these are really, really thin markets. And I'm looking at like the tungsten and rhenium and other markets that go into like nickel super alloys that I know are going to be a big issue, but there's no market for them. There's no way for you to really take advantage of them because you're not going to go and buy, no one's going to come to you for your 100 pounds of rhenium that you got sitting in your garage, even if it does go up 30% in price. It doesn't, you know what I mean? It's like, there's a reason why these are real markets and why they're traded the way they are, and you're talking about, real premiums and real issues and real, who are you going to sell it to? It's getting into the trade is easy. Getting out of the trade is always the issue.
Mm-hmm. To that point, I have plenty of tungsten. Being with my background in welding, I have plenty of tungsten. But
right.
there's no point to it in short little 8-inch rods, right?
Right. If you're really interested, like, are you saving your nickels and not spending them because they're worth more than 5 cents?
And again, if we're playing with a speculation or for the purpose of speculation, there's probably better vehicles.
Yeah. Oh, absolutely.
David, did you want to jump in and add something there?
Yeah, I can't add much. First of all, Bob's right. The big player right now is hydrogen catalyst using platinum. So platinum's a catalyst for the hydrogen economy. And I'm a member of the Platinum Guild, or was, and I get their publication. And it's been over a year now, I believe. And they have made a lot of noise about going back to platinum-based catalytic converters because of the cost structure between palladium and platinum. But it hasn't happened yet. But there are supply dislocations because of where platinum comes from, South Africa. It's terrible conditions to mine platinum. They're down in extremely hot conditions and all that. Just the noble metal. It's 15 times rarer than gold. And just to go one step further, I've probably done more platinum trades than anybody on this call. And I can tell you from my vast experience that you always pay a nice fat premium when you buy and you take a pretty steep discount when you sell. When I got here to Spokane years ago, I wanted to sell some platinum. I went to a dealer. It's a pretty good sized dealer here. Because remember, we're near the Silver Valley. And boy, I took it as far as the discount I had to give him. But he could only wholesale it out for me. He wasn't trying to rip me off. He called the wholesaler and says, what do I get for this kind of platinum? And as Bob said, it was European and, the 1 ounce wafers, and away I went. I'm not complaining. I'm just letting people know that the gentleman talked about doing it synthetically. If you're looking for a pop in the price, is a smarter way to go. So I'll leave it at that.
Yeah. And as far as just being a chemist and having worked in this field, and it's an 80-20 platinum ruthenium catalyst is going to be the best for the hydrogen generation economy. And so if you really want to spec back, then go look into the ruthenium market and then tell me if there is one.
Interestingly, to kind of add to David's point, I did an interview today with Jeff Christian, and that'll be coming out on Monday. But he basically said the exact same thing as you did, David. That the platinum coming out of South Africa is going to get harder and harder to get. The platinum is just going to keep getting harder and harder to get, and the demand for it is not going anywhere.
Hey, Tom, can I chime in really quick?
Yep, go ahead, Steve.
I was trying to leave, and I keep hearing all these interesting topics come up, and you guys, I keep getting sucked back in. This is such a great conversation. Yeah, I've been tracking platinum pretty closely too, and I've been following David for years, and I learned a lot about platinum from him. But I'm looking at a ratio chart right now of platinum versus silver and platinum versus gold, and we're at historic extreme undervaluations that are seen once per generation, if that. So I'm very bullish on platinum for the three reasons that were already mentioned: hydrogen technology, substitution for palladium, and then also just simply investment demand. If just a little bit of money pours into this sector, it can go up. However, like anything, just because it has all that upside, it's not a replacement for silver and gold. It's not a monetary metal per se. But, for those with the risk tolerance and, have the speculative risk, I think owning some physical platinum can make sense for some people. And, I've been personally accumulating some. So just wanted to jump in there with that.
Mm-hmm. Yeah, it's interesting. When I interviewed Andy Hosey from Finding Value Finance, he had kind of developed a model of trading back and forth when the ratios get to extreme levels. And I don't know if he had actually done that, but if you retrospectively look back and trade once the, let's say, silver, gold, platinum, palladium get to these extreme levels, trading back and forth can become very interesting. But again, you need a real long-term timeline to be able to capitalize on that.
Yeah, absolutely. It's easy to say, hey, well, I'm going to swap platinum for gold or platinum for silver, but the liquidity becomes an issue. But that was my last point. I'm going to go ahead and sign off. But thank you guys so much for letting me chime in.
Thanks, Steve. Enjoy your dinner.
You too.
Happy. Do you had another question?
Yeah, sure. And can you hear me all right?
Yep, sounds good.
Yeah, going way back to the beginning of the conversation, when Bob was talking about the leverage ratio of open interest to the physical available at the COMEX. I guess how can you accurately measure how much physical is available to back these contracts if we don't know the various encumbrances that could be on the metal at the warehouses? And for example, last year the LBMA's annual report said that I think 103 million ounces, something like that, of silver stored in the warehouse was allocated to SLV. So that wouldn't really be, something that could be used to deliver against contracts. Am I thinking about that correctly?
What I look at is the metal that's in the registered category, not necessarily the eligible and registered. You're right. If you throw the eligible in there, that's private metal. It could be anything. It could be ETF metal. It could be proprietary trading desk metal. It could be just normal clients just storing their metal at Brinks in New York, and it just happens to be a 1,000-ounce bar that's eligible for delivery onto the exchange. But if you look at the registered metal category, that metal is that's physically audited, and the clearing firms actually, when that metal goes onto the exchange, it's actually under the name of the clearing firm at the depository. So they have to have that metal there. It's part of the rules of their system. It's just the problem you had in 2015 was there just wasn't a lot of metal put onto the exchange, and so you had this really, really blown out leverage ratio. But that's why I was kind of saying earlier that the game has kind of changed, at least on the COMEX, on the metal that's in registered category. On silver, gold, they have a separate category for metal that may have been pledged, which is probably more what you're looking at or what you're talking about. But on the registered category, that's just metal that's sitting there that's basically attached to a warrant. Now, not to say that a person could take their futures contract, if it's fully paid for, their warrant, for example, and use that as collateral for financing or to buy more contracts with, or whatever it may be. You're absolutely right there. That could be something, but that's more on the warrant, not necessarily on the metal. That's why it's frustrating with London, because London they don't really have this audited function that every depository has to be audited, and all that metal has to be separated. And if it's banks allocated accounts, for example, backing, or banks unallocated accounts, and they have say 1 million ounces sitting in a vault, but that 1 million ounces is basically representing 5 million ounces of client liabilities, for example. It's that part isn't really disclosed or transparent, and that's where it gets really frustrating, and it becomes a guessing game. Because if you look at London and you look at the 1 billion ounces that they have, or whatever that number is, I don't know if you really can separate out unallocated versus allocated. I mean, you're right that it could be, it gets really difficult to dissect. Unlike the COMEX, which does try to break out at least the futures contracts, metals versus non-future contract, or metal that's on warrant and metal that's not on warrant.
Thanks, Bob. Andreas, you raised your hand again. You had another question?
I was just curious, so I guess, I had a couple questions answered. So do you think in the metal space, not necessarily precious or industrial, but which way do you go? I know this is hey, naysayer, not naysayer, but future stuff. But do you think the industrial metals will be worth more than the monetary metals? That's it. Just a basic, a 50,000 feet out view, macro. That's it.
Can I grab this one real quick?
Yeah,
because I'm gonna drop off the call right after this. So I just want to say thanks to everybody for showing up tonight. This was a lot of fun. I would say we're already probably seeing most of what we're going to see out of the industrial metals, and we haven't seen the monetary metals move yet. We've seen the industrial metals double, triple, quadruple, and we've seen the monetary metals not move at all. The bull market in industrial metals is probably, not to say that I don't think that you're not going to see a big move in copper. I think copper's setting up for a move to $7, but I think we've already broken the nickel market once. I don't think we're going to break it again, and if we do, it'll be in the context of the monetary metals blowing out and the monetary system seizing up. So I think that's what you should really be bracketing for more than anything else. Thank you very much, guys. I need to run. You have a great night.
Thank you so much for joining, Tom. I really appreciate your input here.
Mm-hmm.
Go ahead, Bob.
Oh, no, I was going to say, Tom is, I think, spot on. And I think David would probably say the same thing. The monetary metals, we're getting into a point in macro, sort of the macro theme of people are looking to preserve wealth at this point, or it's basically a return of capital versus a return on capital. Not to say that the base metals could certainly become it'd be hard to say, but they could become a currency in of themselves from a national security perspective, where countries are starting to hoard base metals in order to make sure they can maintain product and services in the economy. But I think the precious metals, I think we've all been, like David always says, scary out, wary out. I think we've all been basically worn into oblivion, waiting for these moves to happen. And you certainly see the frustrations, but I think I think our day in the sun is coming.
Yeah, that's a great point, Bob. And so, what do you think the idea of demand destruction is going to have to do with, in some ways, the destruction of the commodities super cycle narrative that we've often heard?
Yeah. On the precious metal side, the problem with demand destruction isn't really the demand, it's the supply of just getting these products.
I meant more on the base metals and commodities side.
Yeah. That's what the Fed is trying to weigh out here, with basically the cure for higher prices is higher prices. The problem you run into with commodities in today's environment is the central banks really only have the tool to either expand the balance sheet or reduce the balance sheet. And if the dollar, with what's happening with the dollar, and you're becoming a multipolar type of currency environment, like Jay Powell was saying, that there's room for two currencies, you're having less potential demand for dollars going forward. These countries, which we typically recirculate their dollars back into U.S. Treasuries and use those as reserves, may end up seeing more value in storing commodities in order to preserve, social stability or just their own economy. And that's the world that I think we're entering into, because if you look at these, I think a lot of the guys put these 100-year charts out on commodities relative to the S&P 500. And, I think this is the third time we've been in this really steep trough where commodities are very undervalued relative to financial assets. I think that's the theme that's probably going to take commodities higher, is this shift from, so-called paper assets and just storing your money in reserves and in treasuries. It's, the theme may change where currencies, you're not always trading in dollars around the world. Countries are trading with each other in their own currencies. And that's going to probably put more pressure on commodities going forward. Yes, there's going to be ups and downs, but I'll kind of let David kind of talk about this too.
Where the base metals, as everyone has said, have probably made most of their moves. I just did a speech down in Las Vegas, and I pointed out all of the metals have made some gains versus their 1980 high, except silver. Silver is at about half of what it was at its 1980 high. I didn't know it until I made up the chart, but iron is up about 600% from its 1980 high. But the demand destruction is a hard one to figure out, because if we have a population declining more rapidly than it has been on average, then you've got less mouths to feed, less people buying gasoline to travel, and that sort of thing. I'm not predicting it, but I can say with some authority that if you look at the death rate, it is accelerating, especially in the Western, what we call the free world, which doesn't really exist. I think there's no move to anything like there is to gold and silver. I'm like the old cranky old man, but there's no fever like gold fever. When people are concerned about their money, which is almost everyone on the planet, and they're in fear that either a bail-in could take place, or more importantly, it's going to be less valuable a month or two from now or a year from now, they will seek whatever they have to protect themselves. And that is buying more of something. And if you have anything left over, that means buying precious metals. So the run to gold, I think, has already started based on talking to people like Bob, talking to some of the biggest dealers in Europe, in Australia, in Canada, and some of the other associates I have in Mexico. I think that the gold run has started. And what I mean by that, I mean people buying physical gold that have $1 million in their account, never bought gold in their life, call me up, do a consultation, said, I'm scared of getting ripped off. Who do I buy it from and where do I store it? And that's happening more and more and more. And it's just beginning, in my view, for this next leg up, which will be the biggest leg up as far as price appreciation in paper terms, and probably not that long a duration. That's my 90% of the move in the last 10% of the time, which, by the way, the first time I heard that came from Jeffrey Christian. So that's what I see. I do see further appreciation in, all the commodities. Of course, food's at the top of the list currently, oil's there as well. But run to metals is just getting started. It'll spill over into gold, because once gold goes to a certain level, like 3,000, 3,500, take your number, there'll be a spillover. Oh, man, I could buy 1 ounce of gold, or I could buy so many, ounces of silver, so much more, and I'll buy it. And the ratio will start to collapse, and it'll go from 78 down to 38, down to 28, maybe down to 16-1. I don't know. What I do know is that there's a very tight structure to the silver market, and there is a very tight structure to the gold market. There's more games done with the banking, bullion bankers, as far as what's there and what isn't there, than most people are led to believe.
Thanks, David. Rude Awakening, you've been waiting patiently. What's your question?
I there. Yes, this is a great venue and a great education, and I'm really a novice at this, so I hope you can understand my question. And also, I didn't know Twitter had a venue like this, and I guess Elon Musk has already got busy on Twitter. This is a great venue, but I'm curious. Through the years, I was in the market in 2008, and I got burned really bad, so I swore off the market. And I'm also in gold. But I'm at the point now, and I've been in real estate, and I'm at the point now, it's almost we can't find any place to put our cash. I mean, it's like, at one time you could put cash in the bank and get 2 or 3%. You can't do that anymore. You really can't buy real estate at these prices. And then everything could crash, and you're left holding the barrel. So, I'm leaning toward, more gold and silver and commodities. But my question is, and this is really a simple question, if it hits the fan, how are you really going to trade in gold? I mean, how are you going to barter with gold bars? I mean, if you do have possession of it, I wouldn't even think about not having possession of it because of the possibility of, the middleman says we don't have storage for it, blah, 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 or, we can't fulfill the paper order. So, on a just a realistic basis, day to day, say like I'm home and I need to pay my utilities and all I've got is gold. And that's what we've got going is gold. How do I use it?
Well, if I could be so bold as to jump in first on this one.
Yes, go ahead.
So I wrote the 10 Rules of Silver Investing. You might look it up. 10 Rules of Silver Investing by David Morgan. It'll pop up somewhere. It's all over the web. And then the first rule, this is from my memory, but it goes something like, no one wants to be a prophet of doom, but in the unlikely event of a financial collapse, silver will be the money of last resort. Gold will have too high unit value to be used in barter, whereas silver will be used in everyday transactions. And therefore, I recommend every investor have a bag of silver as part of their asset holdings. So that I wrote in, 20 years ago.
Right. That's when I bought my silver and gold. Yeah. I must have been listening to you somewhere. Okay. Well, that helps me.
Okay.
Thank you.
You're welcome.
Mist, you have a question? You've been waiting patiently too. Thanks for everybody's patience here. This is, again, the first time we're doing this. It's awesome to have everybody interacting here. So go ahead, Mist.
Thanks, Tom. I really like your work. I got a comment and then a question. So my comment is this. A lot of time spent talking about these vaulting schemes and the PSLV and the SLV, GLD. My view is this. Just pony up, buy some physical. Don't expect to sell it for 10 or 15 years. And chances are you're going to be well rewarded for that. The schemes are great for trading and lots of commissions and fees, but they're probably not best for regular folks. That's my comment. My question is maybe David or since you've got, followed your work for so long as well, Russia seems to just completely outmaneuver the West with their recent change in terms of sale for their oil, taking rubles or gold and then putting the floor under gold. The gold market doesn't seem to have really reacted. It's been a few weeks. Do you care to speculate on what we might expect to see maybe in the next couple of quarters? Thank you.
Bob, you want to take that one? You want me to chime in?
Yeah, you go ahead.
Well, first of all, the 5,000 rubles for a gram of gold is what Russia will buy from their miners in-house. They'll probably buy it on the open market, but that's not exactly what they said. And the other thing that's more important to consider is that it only goes till June. So that edict is good for the rest of April and all of May. So it's only good for about 6 more weeks. So being the conservative thinker that I am, I have kind of a wait and see attitude. But I will state that if and only if they actually do tie it to gold directly, in other words, we only accept gold for payment, which is very, very doubtful, then they've changed the game entirely. Right now, when Europe buys gas from Russia, they pay in euros, It goes through one of the Gazprom banks, one of the biggest, banks in Russia. They convert in the foreign exchange market from euros into rubles and pay final payment in rubles. So it does put an increased demand on the ruble, but it isn't like every European's out there going to their bank and putting a ruble account into their banking system. So it does put pressure on it. It is important, and it could be very important. But right now, I think there's too much conjecture of what it really means. I said it doesn't mean a whole lot yet. I want to wait and see.
Yeah, and I think you could almost take a look at how that conflict or war is going too. I think that's actually also influencing some of the ruble activity. As well as the central bank, they went ahead and lowered rates today as a confidence booster that that the ruble is stabilized, and so I think the central bank head over Russia, she's very smart. She's well regarded, I think, in the banking community, but I think they're putting together, they're dealing from a pretty bad hand, so to speak. Compared to the West. And I think using these sort of headline-driven, sort of moral suasion type of tactics, I think they're gaining at least the narrative, which I think is what's you combine that with some of the impact that, like, for example, when Gazprom does go into the market, sells euros and buys rubles, it gives the ruble some additional strength right off the bat, and they throw in that narrative about gold, and all of a sudden, it stirs up a hornet's nest. So there's a lot of games that are sort of being played behind this under the table as well.
Absolutely. And just to kind of, again, reiterate a little bit about what David said, in my interview with Jeff Christian this morning, he brought up the fact that was only for the domestic producers and, in some ways the banks that finance those producers. So it's not necessarily always exactly what it seems. And that had kind of spiraled into this idea that there was an arbitrage opportunity, that if the ruble really starts to appreciate and gets over that 5,000, 6,000 ruble per gram level, that people would start selling to Russia. But that was only, again, available to their domestic producers. Any more questions, guys?
Yeah, I have one. I guess going back to the base metals versus precious metals conversation, isn't the real difference between the two the existence of a bullion banking industry? So the base metals are almost entirely a physical market, whereas the bullion banks create effectively a clone of the fiat banking system, but for gold and silver, and that creates leverage in the system. And there's effectively a possibility of creating a bank run type of situation in gold and silver if physical demand started to overwhelm some of that leverage. And actually, I've spoken with Jeff Christian myself a couple of times, and I asked him this question, and he presented it in a way that was, he was trying to say that the bullion banking industry isn't that leveraged. He was saying the leverage ratio is typically around 10 to 12 to 1 versus, say, the fiat banking industry is more like 100 to 1. So, we could only pull out a very small percentage of cash before the banks would be in trouble, or the government could just start printing more cash. But with gold and silver, you have more of the classic pre-Federal Reserve situation where, there can be a true banking run because you can't just print more gold and silver. And the potential for that leverage ratio to collapse, even if it is only 10 or 12 to 1, is what presents the massive potential upside in say, a very bad situation where everyone's all trying to pull out physical at one time. The people with physical would see very large appreciation due to the collapse of that ratio. Is that, am I thinking about that correctly?
I'm happy you said a mouthful, and it's interesting that you brought up Jeff, because Jeff has said in the past that the gold silver markets are the only markets in the entire commodity sector that are the financial guys to be identical in leverage to what we have in the banking system. So in other words, fractional reserve banking and fractional reserve bullion banking are a match. Those are my words, but he said they were identical. So that would mean they're identical or nearly identical. Has it backed off? Yes, I have not been on the total conversation, as Bob probably pointed out. The leverage ratio on the COMEX using the registered category only is probably not as leveraged as most people think. But I mean, Jeff testified to the CFTC way back in the GATA hearings that the leverage was 100 to 1. And that's straight from him. And that's probably more accurate because we don't know what the leverage is in the LBMA. We don't know what the bank swaps look like. We don't know what the, let's say, some of these mining contracts might look like on the conglomerates, or even some of the bigger miners that may have something out as far as a private contract for gold at a certain price at a certain date at a certain time. So there is a lot of leverage in the metals. And as you said, Happy, and thanks for being here, it's good to hear you. A bank run is probably what it's going to take, or something that comes to the surface that scares people into a bank run. And what do I mean by that? It's the same game that's played from the beginning of the goldsmiths, where they had all the gold, they gave out these receipts, people traded the receipts, not the gold. The goldsmiths figured out that they could put out a lot more receipts than actual gold, so they started to leverage it. They got too greedy, they put out too many receipts, and people started saying, wait a minute, I don't think there's that much gold in this town. And people went to the goldsmiths and said, I want my gold. And guess what? When you have 10 times more paper than you have gold, there's a bank run, and not everybody gets their gold back.
If I could jump in, I think we're about to enter a rabbit hole here. There is so many second-tier effects, second and third-tier effects that could start to unfold if you start to see a demand for delivery. And I think we kind of talked a little bit about the derivative structure and these derivative products earlier in the call. However, let's take, for example, let's say Bank of America, they have a product that, is paper in nature. And all of a sudden you get let's say they have, the calls that they're, for example, using to hedge upside price action, for example, like calls on futures contracts, for example. All of a sudden you start to see this rush for metal starts leaving, the prices start going up, and that call that is a hedge, what happens if that call has to be exercised to protect their underlying position, for example? That's a lot of capital that all of a sudden an institution or a trading house could have to come up with to exercise those options. And that's something that not a lot of people think about. Is that's the second tier leverage that starts to get. It's like an onion. It starts to get peeled back. It may not look like a lot of leverage up front, but it's these vehicles or products that are used that are leveraged in and of themselves, and that's where that's why I think the physical market, if you really wanted to break the market open, if someone wanted just to say take delivery of a crap load of metal and take it off the exchange and just tuck it away somewhere, that removes probably or potentially a lot of vehicles or a lot of underlying derivative contracts that base off that metal. It's almost like the Big Short, where they're explaining CDOs and CDOs squared at the blackjack table, I guess it was, where you have a bet that's made at the blackjack, then all of a sudden people are betting around that bet, and then people then are betting around the bet that's betting around the table. I mean, that's this nature of I think that we haven't really looked at yet, and no one's really tested the space. And I think this way the system is designed at the COMEX, that's why they have these position limits and so forth, so you don't have this unruly move in the metal prices, or potentially protecting the positions or of the clearing firms and that type of thing. But that's these rabbit holes that could start to unwind very, very quickly. If that kind of helps. I mean, we could take this into a lot of different directions right now.
Yeah, I guess an unwind of that leverage, that is essentially a deflation in gold and silver. Like we think about a historical bank run before we had a lender of last resort. People had deposits at a bank that they could use as money, but then when the bank fails and those deposits disappear, there's less money in the system and it's deflationary. So the people with their dollars went up in value. We had actual large amounts of deflation at various points in our history prior to a lender of last resort, and people's dollars went up in value and could purchase more goods. So I just see the gold and silver markets kind of in that way, where there is no lender of last resort for gold and silver. So if you do start to get that leverage unwinding due to physical demand and the physical not being there to underpin that derivatives market, then you effectively get destruction of gold and silver deposits that people have, and there's less paper gold and silver that can be traded back and forth in the system, and the total supply, paper plus physical, shrinks, and you get deflation in terms of gold and silver, and they can purchase more, and that's essentially what causes the price to rise.
That's an excellent summary. I mean, because it's basically leverage working in reverse, but the underlying asset is not a dollar; it's an ounce of metal. I mean, because you could take this in directions where, if, for example, central banks are looking at gold as a neutral reserve asset more and more. People talk about confiscation, but confiscation is not going to be the issue. The issue is going to be what happens if the government feels, okay, maybe we need to go to these financial regulated products where they have force majeure clauses, and people have already signed the agreement and they've already agreed to the potential of a force majeure, especially if it's a regulated product or a financial product. There could be a lot of disruption if they, for example, let's just say they wanted to place a value-added tax on precious metals held in London, for example. The cost of carry just went up. If they do a value-added tax at 20%, all of a sudden, a lot of players, especially if you're leasing, all of a sudden there's the potential of a 20% rise in the cost of the metal. To basically to either get that position or trade back into that position. I mean, these are the things that not to say that they would do a value-add tax, because if the government knew that would basically disrupt the markets big time, I think that's probably why you wouldn't see it. But there's other ways to do that. But I'm just saying that there's the leasing costs. I mean, that's why I go back to leasing. If leasing costs started rising, that could create instability just in the way the refiners and how a lot of these balance sheet financing operations would work. It starts to pose pressure there. And then how does, if leasing rates go up, how does hedging, just simply spot price action, actually affect a lease rate? And I mean, there's a lot of different things that could start to unfold if you have a demand for physical. That's why I think that the market, I think people are underestimating. It's just that the problem is taking physical demand, it's a pain in the butt. And that's what stops people from probably doing it. It's so much easier just to buy, a paper asset and trade the price and then walk away when you think the price is at the level you think it's going to be, that you're comfortable with.
Just a reminder to anyone, if you have a question, you can raise your hand or just jump in here. Andreas, you have another question?
Oh, yeah, thanks. So this isn't a question for about like, is it going up or down kind of thing? But I just kind of want to tell you guys, whoever put this together, think you're awesome. Okay, so good. So I think you guys could take it to the next level personally. So like the way I did Twitter Spaces, I learned a lot about stocks, and so I go to, let's say, oil, or whatever, and then find good people. But I think you guys are onto something. I think you're the seed, but I think you guys could really make this into something personally. Like you are the precious metal guys. And so don't let anyone like take it away from you, blah, blah, blah. I just want to see you succeed because in my opinion, like this information I got just from like this space tonight is way more than I could like between my real job and looking at stuff. I mean, you guys gave it to me. And so I'm going to go research a bunch of stuff on my weekend off. I mean, you got to come up with a catch name, just my opinion, and go from there. That's it. Nothing about anything else.
Thanks, Andreas, for that great feedback. I mean, that's the whole reason we wanted to try this. And again, I really want to thank Bob, David, Tom, Steve, everybody for their time, because it really, I think what gives this value is everybody's input and as well everybody's questions. We had a chart guy that had a question here, but he just dropped off. Anybody else have a question right now?
Yeah, I got a question. Can I ask?
Yep, go ahead, Steve.
Thanks. I've been dying to ask this for a while. So one of the main reasons for having the physical metals, precious metals like gold and silver, is as a hedge against significant inflation and dollar devaluation. So being in a position, if someone's got their physical assets and then they want to add some on top of that via leverage on mining stocks. So my question is, okay, the reason why we value the metals is because we figure that the dollar purchasing power is going down and therefore we're protected by having gold and silver. My question is, if silver metal mining stocks, gold or silver, any kind of mining stocks significantly raise in value, however, the dollar significantly depreciates in purchasing power, is it worthwhile having the mining stocks? Because even though the value might go up, the purchasing value being denominated in dollars goes down. I'm curious what you guys think on that.
And the answer is yes. And the reason is the adjustment they make. They do a couple things. One is when you buy a working mine, so I'm not talking about an explorer, you're buying an asset in the ground. So at the top of the market, most silver companies sell at 50 times earnings and most gold companies sell at 35 times earnings. And if you just do it on a price ratio, you're paying about 1/10 of the spot market in the ground. So in other words, if you have above ground $100 million worth of gold in the ground, it'd be $10 million. That's what you get paid. So that's number one. So you got to look at it as like it's the best warehouse you could have. It's a warehouse in Mother Earth, okay? The other thing is more savvy types like Keith Neumeyer would immediately start stockpiling silver into their own vaults. They keep it at their facilities, and that would be a backing to the depreciation of the dollar. So a lot would take place with the depreciation of the dollar that some companies would do, some probably wouldn't. And it depends on what space you're in. But I think the bigger companies would recognize what was going on and probably do better. The last thing is, if the run to gold goes as deeply as I expect it to, you won't have an option. You won't be able to get much in size. And the only way to get size will be to either use an ETF or buy a large mining company like a Newmont or Anglo American or Wheaton Precious Metals or something like that, because there's so much money floating around that's going to need a home for security. And there's so many places to put it. And the reason they call it precious is because it is. The precious metals are very small in size relative to what the financial system holds right now.
Awesome. Thank you.
Thanks for that, David. I think that was a great point. Alex, you got a question? Go ahead.
Yeah, I was going to ask. The London Metal Exchange just reversed billions of pounds worth of deals on nickel because nickel miners were going to be shorted. Were going to be done by their shorts. Do you see gold being exceptional to that?
Well, the real answer is I don't know, and probably Bob or somebody could jump in with me here. I think that what happened in nickel, I think, is a precursor for what could happen in the metals as well. I'll leave it in that sense. What annoys me so much is the idea that people like myself, and I could take it. I mean, being called a conspiracy theorist really doesn't bother me. I almost look at it as a compliment. But the idea being that a real market wouldn't allow that. And this idea that we're all equal, except some are more equal than others, really annoys me. So if you've got a big trader in China that's going to blow up some of the mines, then what does it show you? It shows you it's not hedging. If you are hedged, you have exactly what you have, let's say, in the bank or at risk. So if I mine 120 million ounces of gold a year, and I hedge 120 million ounces of gold a year, I am net neutral, delta neutral, because for every dollar that gold goes up, I gain it on my physical gold. And for every dollar that gold goes down, I lose $1 on the paper market. So I'm not having anything at risk. That's what the whole hedge thing is about. But when the nickel market blows up and they call it hedging, they're lying. They were speculating drastically with many multiples of what they actually had. And this is where people get into trouble. And this is how the whole system is set up. And I'm not talking the mining. I'm talking about the financial system.
Can I maybe jump in a little bit?
Yep.
Or
go ahead. You hit a hot spot, so go ahead.
Well, you're that's fair enough. But there was the danger that nickel miners would collapse.
Right.
As in, because they'd hedged badly.
But they hadn't hedged. If they'd hedged, they wouldn't collapse. That's my point.
Well, they'd hedged wrongly. There was a disconnect.
Well, just explain the true hedge. If you didn't understand that, I don't know how to say it any better than what I just did.
No, so what I'm saying is, do you think it would have been better for those nickel miners just to have stopped and therefore no more nickel mining should have happened?
No, of course not. I think that, in a real market, you should be able to do whatever you need to do. And I'm not against hedging. What I'm against is saying that you're hedged and I'm out of business because I hedged. You can't be out of business if you hedge correctly. Bob, you want to back me up on this, what a real hedge means?
Yeah, well, like I was talking about earlier, with nickel, it's an interesting situation because you're talking about product that's always sort of in motion. You know, when you bring it out of the ground and you're sending it on a ship somewhere and it's going to a refiner, it may take a month to get it from point A to point B, into fully refined product. And so that whole month, the base metal type of miners and producers, they work maybe a little bit differently than the precious metals, where precious metals are more stored, they're more hoarded, I guess you could say. There's not as you can move gold, by plane overnight. Yeah, but if you want to move thousands of tons of nickel, you're doing it by ship, and it just takes a lot of time to get there. So that's partly where the London market, like I was saying earlier, the minority of transactions of the world's transactions were done on the London market. Yet that's the market that everyone kind of uses as a price setting mechanism. And so you have all you have to do is have you have hedge funds that come in with a sizable amount of money in an illiquid market, and they could just, you can take the price direction straight through the moon. It's very similar to what you see in the gold market when you see stop runs, or silver markets when you see stop runs in either direction. Someone hits the stop losses either on the buy side or the sell side, and the prices have that big volatile move, and everyone thinks, well, it must be the banks trying to drive the price down. But in reality, there's just a lot of stops under a certain price level that hedge funds or other players are looking. They're looking for price discovery, and if they can hit that and force that sort of cascading effect, they can cover into that. I think that's kind of what you saw in the nickel market in a way, is that you had a lot of stop losses that basically ran into just an avalanche of buying to the upside, and then not to say that, I mean, what the exchange basically did was, I think, just destroy the confidence of trading, on the LME. I mean, for what they did after that was probably just as bad. Not only just reversing trades, but also then coming in with, they took a number of days to start trading again, and all of a sudden, when it's open for trading, it just went limit down, or it locked up very quickly. But the image doesn't look good, because the image basically is, J.P. Morgan, I believe, was a big had a exposure and allowed, I guess, this. I'm sure there was a lot of back office back scratching going on to try and get the Chinese investor or the Chinese trader sort of into a situation where he was not as exposed as much, or I should say J.P. Morgan wasn't as exposed as much. But the precious metals don't necessarily, they're not used in the same fashion as like these base metals are. So the producers, they do have to protect themselves in a certain fashion. I agree with you there. I mean, it's otherwise the market would become it would be very difficult to run a business when you have your product on a ship and you can't really you're selling it to another party, and you're getting 80% of the funds, and that 20% you're not getting until the product's there off the ship and in the hands of the buying party. You have to be able to hedge some kind of exposure.
I think that's an interesting point, Bob. And, when we saw the actions after that, where they said that they imposed a 15% daily limit, is that because they want to change the rules and it's kind of a conspiracy, or is that just to try to be able to manage that market if something like that happens in gold or silver or whatever other market they're managing?
You're absolutely right. I mean, that was designed to try and stabilize the markets. No question about it. I mean, the problem is like these the circuit breakers that you see in the stock market, for example. They're designed to try and slow down momentum. It's kind of like a basketball coach, calling timeout when his team, gets a run against them, to try and slow the momentum down of the other opponent. It doesn't change the structural situation. It tries to change the sentiment of the market, or allow the market to try and reset.
No Stick, you had a question?
Not so much a question as to sit down and say, Dave, I agree 100% with Dave, except what he left out of it, if you don't mind my adding to it, Dave.
Please do.
the buyers on the other side, so you've got the miners that go out and mine, and they've got risks and everything else, and they want to stabilize their price. It's like gold right now. Gold at goes to 1900, then it goes down to 1800, and then 1700, and then hutches and goes all over the place. When you're trying to do a spreadsheet and calculate what your all-in cost is, all-in sustaining cost, and what your profit margin is on something, and your researchers go in and sit down and look at it, and they go, well, how can you predict this? Because your end price keeps going up and down. Well, you don't want to risk it going down too much, so you hedge on the other side. Now, for nickel, it's the same thing. I mean, you've got a whole bunch. Here's your production. Here's everything else. The buyers, however, on the other side, they want to have a stable price to deal with as well. So they go into the market. They hedge their potential future position by buying for future delivery. So you have a stable producer price and you have a stable consumer price or manufacturer's consumer price of these products. Now, based in that, you have the producer versus the consumer, not retail consumer, but industrial consumer, trying to stabilize their price, and you have a bunch of speculators who come in to sit down and add liquidity to the market. So some people will say, well, I'm going to speculate on this. Some people will speculate on this. The difficulty in all of that is if somebody comes in and takes too big a position, and then it moves against them. So if a miner actually goes in and takes too big a position, bigger than his production position, and it moves against him, now he has a major problem. Only when he overdid his hedging more than his production or future production does he end up having a problem. Because if he's overhedged and all of a sudden it moves, now the other side of it is if he hedges too far into the future and too much, like Barrick did, then everybody comes back and says, and gold goes up from 1,200 to 1,800 or 250, wherever. Now all of a sudden all the people that see the hedge position just go, your hedge position is killing you. And they celebrate the people that didn't hedge because they made money. They don't understand the mitigation of risk in your future production and your future revenue on a consumer side or on a mining side is what you're trying to do because you want stability. The speculators who are coming in and speculating want the volatility, but they'll overdo it. Sometimes a speculator will also be a miner. Sometimes a speculator will also be a manufacturer or a consumer because now they're taking risk. They're speculating. They're not investing. They're speculating. And when that speculation gets carried away, for instance, a bank steps in as an intermediary speculator, and they take too big a position, now all of a sudden they get crushed and there's a liquidity crisis come up. And that's when somebody like the commodity exchange or somebody else gets called in to say, look, we have subsequent consequences to this, and it may infect the rest of the system and become a problem. It's the speculators in it that supply the liquidity, but they also add the risk. And that's the problem. On an investment side, on a regular manufacturing usage side, when you're doing spreadsheets, when you're doing all the rest of the stuff, you really don't care. As long as you've got a stable price on both sides, you can work your numbers and see whether or not you're going to make your point. And that's what the accountants, that's what the CEOs of those organizations want to do. The other people who are speculating, myself, other people who speculate in it, it's that speculation that gives us the opportunity. But when you get an AMC equivalent of mimes going into something like this, they overdo it. They're not prepared. And now all of a sudden you get overdone, over exuberance, everything else. I trade in markets. I'm used to going no bid because the market suddenly decides there's an imbalance. We're going to stop trading. So to me, that's an added risk on top of anything because the exchanges have the right to sit down and say, no, we're stopping trading. You're going no bid. You've got no price. We're sitting down and suspending it. And I've been suspended in securities I'm still suspended in for a couple of years now. That it comes back, I think, is a miracle. Anyway, that's all I wanted to say.
Thanks for that, No Stick. Happy you've had your hand raised for a while.
Yeah, so I guess going back to the miners versus physical conversation, and I know David is a huge advocate of having physical, but I guess just, and he was advocating for owning miners as well. But I guess I see the physical as kind of a hedge against, or an insurance against true hyperinflation. So in the event we actually had a full dollar collapse, loss of confidence, where zeros essentially keep getting added overnight, Weimar Republic style, then I think owning physical would be far superior in that doomsday type of scenario, just because of the wealth confiscation impact of say mining stocks going up massively in nominal terms, perhaps just keeping pace with inflation, but then the government basically saying, hey, you had $1 million gain on your $50 mining stock, and we have a capital gains tax that we just passed for any gains in excess of $200,000. That's 80%. And all of a sudden you get your wealth confiscated in a true hyperinflation scenario, whereas physical gold or silver that you own in self-custody, or maybe even in a situation like Bob's, where you're the owner of the metal, he's the owner of the vault. You could perhaps hide wealth much easier than say owning mining stocks, whereas mining stocks are better for a situation where you have bad inflation but not hyperinflation. I don't know if David has any comment on that or.
Oh, Happy, I think you're right. I mean, I've always advocated, as you know, physical first, and then the next step up in leverage and in risk would be the mining shares. I think I agree with pretty much everything you said. I mean, if you had a crystal ball and you knew that we were going to go Weimar, you could, look at what happened to gold and silver in the stock market. And I actually did a lecture on that years ago. And you would stay in the miners up until a certain point, and then you would sell them while people still want them and move it into more metal. You come out the other side with more metal. But I think they both have their place, but there's definitely a different mindset to someone that buys physical metal than someone that buys an equity in a mining company.
Yeah, I think that kind of speaks towards my earlier point, to have really, again, those buckets of liquidity so that you're prepared for any eventuality, and hopefully you're paying attention enough at the time to kind of be able to head off any issues like that might arise.
And Tom, I would like to add one thing. I thought of it driving back here, and I didn't voice it yet. One thing about the miners is you don't have the situation we have in the physical market right now, meaning you don't have this high premium. I mean, you're going to get, and you could look at that company, and I'm not talking an ETF like PSLV, where you could look at the net asset value, and you could do a net asset value calculation on some of the larger miners and find if they're overvalued or undervalued. My point is that sometimes, as we are right now, if you really wanted to get in the market, you might take the route of buying a good, solid mining company, like I say, a Wheaton Precious Metals, and then using that as a proxy for physical, with the intent of selling it and buying when the premiums come back to more reasonable level. It's just something to throw out there. I mean, I've done that in the past. Sometimes, in fact, you can even plot it, Happy, if you wanted to. You can look at what the premiums are in the metal versus what the premium is on, let's say, the top silver stocks, stock 7 silver stocks, and see, what that ratio looks like and when you might be more favorable to trade one against the other.
Yeah, it's interesting, David, that you bring that up. When I've spoken to some asset managers, they talk about buying, however many millions of ounces in the ground for, $6 an ounce, basically, when they're investing in a miner like that is severely undervalued by the market, and you're not paying the same premium that you would for the physical ounces in your hand that are minted and in coin form, right?
Right.
Does anybody else have any questions?
Actually, could I step in for one more?
Go ahead, Steve.
Thank you. And this one's a two-part, kind of somewhat hypothetical, but perhaps not. We've already, we're talking about Weimar Republic, and we can look at what's happened in Zimbabwe or Venezuela. So it's not unprecedented. So my first question is, what do you guys feel is the possibility of the U.S. experiencing significant hyperinflation? And I'll give you 3 choices: low, medium, or high. And then if you think it's medium or high, my bigger question is, what is your ballpark feel of how things change with respect to the valuations of the precious metals? We had a question a while back about using metals for exchange for goods and services. I'm not sure how well that would work if you're going to try to pay your taxes or something, because the government wants you to use their money.
But for exchange for going to a market and using silver to buy a loaf of bread or meat or whatever, or exchanging, frankly, I've already seen some articles about people exchanging silver for work done in landscaping or roof work or stuff like that. So I'm already seeing that now. And I'm just curious, if you do think it's medium or high risk of hyperinflation, then how do you see the use of silver or gold for exchanging goods and services? Thanks.
I could say one thing. I think lead would be more important at that point than gold and silver. That's just someone from Idaho here. But I think I don't see it would be difficult to see the currency just completely collapsing, because the government still has the ability, if it does have, let's just say it does have the gold at Fort Knox, but the government, I think you would see not necessarily a seizure of metals or whatever it takes to sustain or stabilize confidence in the system. But that's why I kind of go through that scenario of, if we got to a point where the public was buying metals, the dollar was starting to fall after, let's just say it has this massive run to 140 or whatever, you have this massive dollar squeeze. Other countries are falling, and the U.S. is the last to fall. You may see rules instituted to try to stabilize the balance sheet of the U.S. government by going after the COMEX or some of these other regulated products that, like gold ETF or whatever it may be, and try to do some type of force majeure in order to, for the central bank to basically cash settle, take the metal onto their balance sheet, being able then to strengthen the balance sheets to go ahead and loan money to the U.S. government, who's probably borrowing money just to, at that point, I don't even know if they're servicing the debt. But it may be used as a neutral reserve asset. That's the part that gold will help stabilize. But if, obviously, if we don't have any more gold left in Fort Knox and the coffers run dry and, we have social chaos in the streets, because that's typically what will happen if you have hyperinflation. At that point, it'll be more of a rule of order, I think, at that point, than it will. You probably won't find any products on the shelf at that point.
That kind of goes to that idea of, you don't want to live in a $10,000, $15,000 an ounce gold world, right?
Yeah, that's the double-edged sword, and we may be the last asset class to go up, but when it does, it's not going to be rainbow and unicorns out there. It's going to be a different world altogether.
David, did you want to add something to that?
Not much, because you qualified the question. I'd put it at medium to low. In advanced capital markets, the whole structure runs on petrodollar, which is collapsing slowly, or slow relative to what it could do. And all that funny money, not all, but a great portion of it's going to go to monetary heaven. All debts get paid. But when you loan your brother-in-law $10,000 and he never pays you back, you're the loser. That money's gone for you. And that's what's going to happen. So as interest rates get pushed higher, and I don't think they're going to go a lot higher, but that devalues the bond market. But at some point, it's more of a trust issue. It's a confidence issue. When people lose confidence in what the dollar is, either short-term, a T-bill, a dollar bill in your pocket, a 1-month note, a 2-year note, a 10-year, or a 30-year, it doesn't matter. It's all the dollar. If it's either short-term or long-term or immediate, they lost faith in it. Once they've lost faith in it, you're done. And that's when the run to gold will really start, and it's already starting. So it's confidence. What do I have confidence in? So inflation, deflation, stagflation, in combination thereof, it's confidence, and gold and silver are what historically have been the most sought after. I think it'll be true. Certainly, it's already pervasive in India. It's pervasive in most of the Asian countries. It's not so much, it's in South America, but it really isn't so much in North America, although the North Americans buy more silver per capita than anywhere in the world. It's funny that they are not used to, let's say, what the Asian market would be as far as when times get tough. They'd have no trouble exchanging precious metals for some food stuff or rent or something like that, whereas it is done here and it's done more often here, but it's not something that's actually built into the culture anymore, whereas in those other areas it actually is still part of the culture.
Thanks, David. Everybody, just another reminder, if you have a question, put your hand up. Alex, you have another question?
Oh, could I add to that?
Go ahead, Happy.
Oh, I was gonna say probably very to extremely low of true hyperinflation. But I like to think about gold or silver as an insurance product against hyperinflation. And if you think about a very unlikely event, say like the death of a young person, age 25, they can buy life insurance for a couple $100 for that would pay them $1 million if they died. And because that's such an unlikely event. But if we have a 1 in a million chance of hyperinflation, when we have inflation running at 2% a year, and all of a sudden at 8% a year, the odds of true hyperinflation are now 1 in 10,000 or 1 in 100,000. Still incredibly unlikely, but the value of that insurance has gone up 10x or 100x because it's only a few. And I'm getting to statistics a little bit, but there's fewer standard deviations away from where you are now at 8% inflation, or if we get to say 15% actual inflation to true hyperinflation. So I just see it as it can be incredibly unlikely to have true hyperinflation, but as inflation goes up, it's closer, and it gets exponentially more valuable to own gold and silver because there's fewer standard deviations separating you from a hyperinflation scenario.
Well put there, Happy. Nikki Shields, you have a question?
Yes, I do. Hi. So I work for a precious metals firm, and I just would like you to, in my mind, just explain why you think precious or physical is the best way to hedge against these sort of like hyperinflation, Weimar type scenarios where I've seen back in the past, whether you're seeing like MENA in 2011 or other scenarios where it literally is a dash for cash. We see Lehman, we've seen MENA. It's gold gets sold. Cash is king. So is that is the route for how do you think about precious metals being a hedge against that? And is it a hedge against the fear of the ultimate crisis and up until the point where you actually liquidate for cash? Or like, how do you see that playing out?
I'll go ahead and take it first. And, I'm not opposed to differing views in mine. Yeah, I think you said it quite accurately. I mean, cash is king. I mean, a lot of times when we've had the
crisis, cash king.
Sell-offs with the 2008, and even the mainstream calls it a financial crisis. You name Lehman. There were others, as you well know. And sell gold, get the cash. So the way I look at it is the way I was taught, really, by John Exter of the Exter Pyramid. If you're not familiar with that, you're going to have to Google it. So cash is the most trusted until it isn't. And that's kind of what I said on my the last question I took a stab at. And so cash is the best until it's not the best. And that's the problem. That's why physical trumps everything. I mean, if you want decentralized, anonymous cash, it's gold and silver. It's outside the banking system. It's outside the financial system. It's private, it's unknown, and it's ubiquitous. It's known everywhere. I mean, that's why in a survival kit, when you're a fighter pilot, you've got a gold coin in there. They don't give you a $100 bill. They give you a gold coin because anywhere that you bail out and are lucky enough to survive, drink your water, and get on your 2 feet again, that gold coin is going to get you something that you're going to need. So that's the bottom line. Cash will work until it doesn't. It's failing as we speak. I've been on this mantra since I learned about honest money and what the banking system really works like, and all fiat fails. So I guess the better question, I'm not saying your question wasn't excellent, is, David, when exactly is it going to happen? Because if I know it's going to happen 3 lifetimes from now, then I'm probably put too much in the metals. If, on the other hand, I'm correct and it's going to happen within the next 3 years or so, then I'm positioned quite well. But I can't give you that answer. I don't know how soon it's going to be. And I'm sure Bob or Happy or somebody probably want to add on to that and maybe poke holes in it. But cash is king until it's not.
Yeah.
If it all falls apart, why would you want your gold?
Sorry.
Go ahead, Bob, if you want to add to that.
Yeah, the way I kind of look at the metals at this point in the markets, it's the 40 years of kicking the can down the road. Going back almost to the 90s with long-term capital. Then you got the Nasdaq and Y2K, and then you have the 2008 crisis and basically the beginning of QE there, and then you have 2018, and you have the repo market blow up, and then 2020. I mean, you go through these scenarios, and it's embedded in people that the only tool that basically the Fed has and central banks have is to expand the balance sheet. And at some point, they're going to expand it too much, or it's just confidence is going to start dropping, and that's where we could be with these metals. I mean, with this, I think Russia kind of threw this hand grenade right into the middle of the financial system in a way, and it exposed some of the fallacies of reserves and so forth. And that's why I kind of brought up the money that's sitting on the Fed's balance sheet, for example, this reverse repurchase program, RRP program, which you get 1.7 trillion or so in that program, and everyone thought that was going to start running off back into the markets after December, and that's still on the Fed's books. It tells you people are getting really nervous, I think, from a liquidity standpoint. You're probably right. Cash would probably be, if you get a deflationary crash or something of that nature, yes, cash would probably be king from a strategic standpoint. But we're living in a world now where the only answer is to expand the balance sheet, and that means potentially inflation, maybe not necessarily on the Main Street side, but on the monetary side, and just the idea of when can these debts ever be repaid. It would be impossible to do that in a deflationary crash. Too fewer dollars would make it almost impossible to pay off all these debts. So, and in 2008, the odd thing about 2008, there was only 2 assets up then. That was the Treasury market and gold. So gold did perform. I mean, it didn't go gangbusters to the upside, but you've seen these big drops, like when Russia invaded Ukraine, and you saw the dollar go up and you saw gold go up at the same time. I mean, you're seeing these breaks of correlations that I think more players are noticing. And so, I mean, these are the crumbs that you try to pick up on, and you try to look for any type of changes in trend, I guess you could say.
Yeah, I mean, yeah, absolutely agree. I think the fact that how gold has performed and how it's held up in the face of a much stronger US dollar, in the fact of higher real yields recently, the fact that we've had peak war geopolitical premium behind us, it is indicative of like there is a shift. There's a lot of renewed money and focus on gold. It has becoming it's a recession hedge, it's an inflation hedge, it's a geopolitical hedge for sure. But when that does ultimately happen, I do think cash is still king, and gold will be sold alongside any other asset alongside that.
Well, one also important is, I mean, the dollar has been king relative to other currencies. So that this is where I think this sort of break in cash, in U.S. dollar terms, yes, that's been strong, no question about it, and it's getting stronger. It's just that if your cash and cash is king and your cash is euros, you're not doing too great. Or if it's in yen,
Correct.
you're not.
Yeah.
So I guess it's all relative to the currency, and that's part of the issue. I think is the dollar. The way the system was designed, it's designed around the dollar. The dollar will probably be the last thing standing, and then at that point, when it collapses, it's going to be dramatic. But of course, every fiat currency when it collapses is always dramatic. But I think we're just living in a world where we the last 40 years has been the dollar. It's been the dollar everything, and now that's changing. And I think people are recognizing it. That's maybe why these commodities have been very stubborn not to go down when the dollar rises.
Absolutely agreed. I think it's the dollar, the affinity for the petrodollar is diminishing. It's not gonna fall away overnight. I don't see the demise of a dollar overnight. Rome wasn't built in a day, but the whole you've taken a risk asset, used to be a risk-free asset, and now it's no longer risk-free overnight. And it's central banks will be holding less of it. There'll be question marks over it, and commodities are becoming, or real assets, real estates, commodities are back in vogue for sure.
Yeah, definitely. It makes a lot of sense.
Thanks for your questions and joining the call, Nikki. Al Capitan, you have a question? You've been waiting patiently.
Yeah, I apologize if it's been asked already. I've been popping in and out. General thoughts on the gold-silver ratio? Just seems a little weird. That's high with gold near its all-time highs. That's sitting around 80. Thanks.
David, do you want to take that? I know you kind of touched on that earlier.
Yeah, well, the best way I think that I've thought this through is what is the gold-silver ratio? And we all know what that is. It's how many ounces of silver it takes to buy an ounce of gold. But if you look at the gold-silver ratio from the year 1300 to 1873, it never went above 20. And the reason I finally concluded it never went above 20 is that they were both the exact same thing. Gold was money and silver was money. So when silver and gold are money, the ratio is very close to what I call the natural ratio, which is how it comes out of the ground. And even Eric Sprott says it's 16-1, but the truth is it was 12-1 in the 13th century. It's now about 9-1. So, and it actually traded in that range for many thousands of years. It traded at the natural ratio as money. But once it was demonetized by the crime of 1873, we've seen the gold-silver ratio go above 100 3 or 4 times, with the all-time high being 125 or so in March of 2020, because it's quote-unquote not money. Now, the bankers still treat gold as money, even though they don't say it officially. And, Bernanke will say it's tradition, and he can't even define money. And he's the Fed chairman at the time. So if silver's main purpose by the marketplace becomes money, then the ratio will decrease. And that's what we've seen happen. When the big move that we've seen so far in this bull market took place, the gold-silver ratio went from 80-1 when I started the website to 33-1 in end of April 2011. And that would have been a perfect time to swap expensive silver into gold. Whereas you would have been smarter, as I said in Vancouver in my first speech, if you really want to buy gold cheap, buy silver at our 80-1 ratio and swap it for gold when the ratio drops. So it has meaning. And I think it's something to pay attention to. But the idea that it has to be at the natural ratio is invalid in my view. And the reason being is that platinum and palladium are 15 times rarer than gold. So if you use the same logic, you would say, well, platinum must sell for 15 times the price of gold, is 15 times rarer. And it doesn't. So the market, I think, is a good arbitrator of what it is. But since we're in a fiat money system, it's really hard to pin a paper price on anything. I mean, I'm a senior citizen now, but when I started working, I was getting $6 an hour, which is well above the minimum wage. The minimum wage, I think, when I started in the workforce was $2.75 an hour. It might have been $1.75. I really don't remember. But the point being is that when you have a floating worth of fiat currency, then you're going to have to see what happens. And gold and silver done their job. I mean, we've had a compounded inflation rate of about 9%, according to my friend John Williams at shadowstats.com, that uses the CPI based on 1980 calculations, and gold is compounded at 10%. So it's done exactly what it's supposed to do. It's supposed to keep your purchasing power. It's not supposed to make you wealthy, although it can, and I believe it could in the future. But those are extremes that happen really very seldom. Gold usually is more of a constant. Ounce of gold is an ounce of gold is an ounce of gold. It will buy the same goods and services throughout all time. Now, that's a lie, but that's a general idea, is this is very stable. And most of the time it acts that way. So coming back to the ratio question, I think it's smart if you have the risk tolerance to buy silver when it's a ratio of 70 or higher. And I think you should always have some gold. And then when the ratio gets into the 30s, I would definitely think of swapping some out. I do think the ultimate ratio will get back to probably around what they call the classical monetary ratio, because there's a lot less silver available for investment than there is gold, and it's a lot more affordable. And once this next run to gold starts, a lot of people start looking at gold and realize silver's cheap, and they'll run into the market. So I think we could see a 60-to-1 ratio. So if you want my idea on where could it go, that's my thoughts.
Yeah, I think that was well put, David. And I think the one thing that really a lot of people in the gold and silver thing, especially let's say newer investors or people that are just looking at it, it does seem to be an instrument that is used over the long term to correct for these extremes in conditions. It's not a short-term speculative instrument, right? And I think that is something that sometimes gets missed when there are expectations and promises in this space that gold or silver is going to the moon tomorrow, kind of thing.
I guess my point was, are you surprised that as gold continued to move higher, the ratio pretty much hasn't really moved itself? I would assume, not knowing better, that it would come down a little bit.
Yeah, no, I'm very surprised. Very. Really, based on what I know, and if you've listened to me in the past, I like to stick to facts as much as I can. The fact is, in 2020, the amount of silver purchased for investment was beyond belief. It was 530 million ounces. It was about 200 million ounces on the retail side and 320 million ounces through the ETFs. I mean, this was an astronomical amount of physical silver. And yet the price did increase. We got up into the 28 range from 18. But it really hasn't done much since. And most of that silver hasn't been sold back, to the best of my knowledge. Now, I don't know the exact numbers. No one knows. But the published numbers from the Silver Institute and CPM group will give us a pretty good idea. And I suspect we didn't have the investment demand for 2021 that we had in 2020. But I'll bet it was still substantial. And with those kind of off-takes, the ratio should be different. The last thing, and I hate to be Mr. Conspiracy, but I don't mind speaking my strong opinion, is when Ralston Benham comes out and says that they had to tamp down the silver market, and he's the acting chairman of the CFTC, it does tend to raise an eyebrow.
Thanks for your time.
So I want to jump in. I've
Go ahead,
been
Zach.
following
Sorry.
Palisades a long time now, and I don't know if anybody watches on or listens on Spotify. You do the year. There's like a year-end look back, and it was like, holy shit, the Palisades was a huge percentage of my listening. I had to start off by thanking it for you for everything you do, and a lot of hours listening, a lot of hours for sure. And I think it's important for. Hello?
Yeah, you're still on, Zach.
Okay, sorry. Yeah, I just want to, for the smaller investors like us, the guys listening, and I just want to point out, I think we got to look in other ways that to invest rather than just the market, just different sectors, right? Like we believe in metals. Like I'm in Ontario. I've been selling the GTA real estate like crazy and buying up in Sudbury, buying in these metal towns. And just in 1 year, the boom in these areas is insane. Because I think going back to what David mentioned about how platinum, there's always such a terrible arbitrage, what you pay and what you get when you sell. I think, I consider myself a long-term natural resource investor. And I think there's going to be a day where if there's smaller guys like us that can get groups and start to buy direct, I think there's going to be a day that Dory bar is going to be a premium because, those producers, those Teslas, they're just going to need it. And they're not going to care if it's Pamp Swiss. They're not going to care what it is. And being long-term, I think that's going to be, a big win for those who are willing to take that risk. Right. And I just want to say thanks for everything and keep going.
Thanks for your feedback there, Zach. And of course, I can't do any of this without my awesome guests like Bob and David and everybody that I've interviewed and that is so generous with their time and their information there. And of course, the awesome listeners that give us lots of support and make it worth keeping doing at least four interviews a week here. Alex, you had another question?
Yeah, I wanted to be quite rude and ask David, because he mentioned about losses, how much did you lose at your worst?
Oh my goodness. I don't know. Okay, well, let me just say it this way. I did a lot in the futures market. I still do a little. But I'd say the worst loss I took in the futures position was I lost a new Lexus in about a week. So that was probably on paper. I'll add to that story, though, Alex, that you're asking, and I'm pretty open. I had a leveraged account with Safra Bank in Los Angeles. I had several thousand ounces of silver. And I actually had the cash equivalent to back it up, but I had about 3-to-1 leverage on it. And the bank was closing down, and I got notification. So I sold out. I had, I think it was Fidelity. It might have been Lexington, had the Strategic Silver Fund. And I had several $1,000s in that. So I cashed that out. That was one phone call. And then I sold off most of my big miners. So I had enough cash to pay off the debt encumbered by the leveraged loan. And I got the money and went down to the bank. And now I had cleared it. Now I'm taking possession of my silver. So I go in the office, I present myself, give my ID. They actually had a guard come in with me. He's had his holsters. He's got his holster. So they come out and they have a big hand cart and they start wheeling out my silver and taking it to my car. And the secretary says, "Oh my, I've never seen any silver before." And I just couldn't believe what I just heard her say. But they did have a vault. They did have my silver. And whether they were hypothecating more than they actually had physically, I have no idea. But I thought it was very amusing that after going through all the rigmarole that I did to capture and pay for that silver and take possession of it, it was a rare event for someone in the main front office to ever see any of it.
That's an awesome story, David. Thank you. No Stick, you got another question?
Yep. Yeah. Dave, you took away some of my thunder there by mentioning John Williams. One of the people was mentioning inflation and when inflation gets out of hand. So I have a question for you that I've always kind of waffled around the answer for. And that is, we've got government listed inflation as one thing. John Williams and his recalculated inflation, even though it's recalculated, you can still argue it's too high, it's too low, but it's above what the government level is. Accepting that he's correct, that the real level of inflation is above, if not well above, what the current government rate is, would you say that sort of neutralizes some of the intermediate approach to inflation undermining the currency or creating the panic down the road? And secondarily to that, would it be reasonable to assume that this is just winding the elastic band up tighter and tighter?
Well, hopefully I understood your question. I believe I did. I think it's both. I think the one flaw in humanity, so putting on my philosopher hat, and those that don't know me, I do this occasionally, but the main flaw, the humanity, the way I see it, this is my opinion, is that the belief system is stronger than the truth. I mean, the truth is a piece of paper is worthless. That's the truth. But the belief that I have is that tomorrow I could take that thing that says 10 on it and go to Starbucks and buy myself a latte. And chances are I'll be able to do that. So there's a belief that it's always going to be worth something. On the other hand, since there is that delta between the official inflation number and what we're really paying, especially in food and gas now where everyone can see it, it can't be hidden very easily. It is putting added pressure or winding the rubber band, as your metaphor. I agree with that. Something's got to give, and I think it's going to give sooner than later. We're already seeing it, and I've said this 3 times. I'll say it the 4th time before we could close out, and that is that the run of gold, I think, has started. But it starts as a very small walk. You're just walking normally. And then the walk paces up to a brisk walk. And then it goes into a light jog, and then a full jog, and then it goes into a trot, and then it goes into a run, and then it goes to a sprint. And all of that happens pretty quickly. And once that sprint to gold happens, and people rather have gold than dollars, then you're going to see things really take place.
Thank you very much.
I like the way you put that, David. And, I think challenging our beliefs is something that is important. I know being a host and trying to cover all different sides of this and really, as I've said many times before, piece together this worldview from many different opinions is really important to try to be objective and remove some of that emotion from these markets and something that we're all very attached to at this point.
Absolutely.
One thing I would say, I know it makes sense for you, Tom, as a Canadian. I think it would be good to have a discussion about more about flow-through shares, flow-through investing for Canadians who are able to buy shares tax advantaged. Hopefully you can find someone, have a chat about that one time.
Yeah, absolutely. That's a great suggestion. And I always appreciate getting suggestions on what you guys do want to hear about. For those that don't know, that's kind of associated with doing placements, and it's a way to offset some of your tax liabilities. But obviously, I'm not the best guy to talk about that. But I can absolutely try to get somebody to speak more towards that in the near future here.
Rick is definitely the one for that.
Rick is the man for a vast number of things, and it's always a pleasure to be able to get to speak with him.
Maybe David could touch on this because I know a lot of people have had questions on miners. The one thing that if we did have high inflation, maybe David could address. The downside to the miners is their costs of operation start to rise as well, or the cost of production. And I don't know if you've done work on how that relates to the in this day and age where oil goes to $150 a barrel and the energy costs go up. Do you see that as an impact or does the metal just simply outshine and everyone focuses more on the metal in the ground?
Well, I already touched on that, Bob, as you know, and it's, one focus is how much metal's in the ground, and it's just being warehoused. So it's an investment. I'm buying gold at a discount, but it has to be dug out, and that costs money and all that. And then there'll be people who'll be more analytical, and I've got a rule of thumb. I haven't, I'd have to do the calculations to get a real good number, but roughly most mines, 25% is in oil costs. So if oil doubles and that's 25% of your operating cost, obviously it's going to affect your bottom line significantly. So I use that as a metric just to get an idea. The problem is, going back to my statement on belief, these markets are highly emotional. Most markets trade more on psychology than the fundamentals. And the run to gold will be so great, I believe, that we're going to see anything with gold or surrounding gold will get a premium. So that means people that think it through logically, that won't buy it because operating costs are going to go skyrocketing. And even though the gold's at 3,000, it's going to cost them 3,200 to get it out of the ground. Most people that think that way won't buy it because it's logical, but that won't matter because everybody sees that it's a gold mine and they're going to buy it. So there's a lot to thinking from your emotional quotient. You're not your IQ, but your EQ of what happens when people panic. And I hate panic. I don't think we should, we should never panic. But in a financial meltdown, there will be panic. And because of that, you're going to have to think outside the box of what the average person that thinks this is a big conspiracy theory or gold doesn't ever do anything or you're a gold bug or it's a pet rock or all the things that we hear that disparage having a hedge position in the metals will be people first out the door to get it when they can't find it.
Here's an interesting thing too that I look at, because I get questions a lot about, do you use any other type of research or quirks of trying to figure out the markets? Because everybody, I know David has his tricks of the trade, so to speak. But one of the things that I've seen in this market, especially like the media, they'll use sort of hit pieces to try to quell either public opinion. And we saw this. There was interesting in 2015. There was an article in the Wall Street Journal that talked about. It was the day before the Fed hiked rates for the first time, and they talked about how basically gold was a pet rock. And it just so happened that when that article came out, that marked the bottom of gold, basically. And then the same writer wrote an article in 2018, and I think it was in October of 18, when gold was $1,200 an ounce, talking about how gold will fool the bulls, so to speak. And so right when that article came out, that marked the bottom. And then oddly, in August of last year, we had this big meltdown on a Sunday night. And it just so happened the day before there was an editorial or the writer of this art, the same guy wrote the other two articles, wrote an article talking about how gold was a terrible inflation hedge. And so sometimes you can look at these things out there and not that it has any meaning to hyperinflation or anything that we were talking about, but sometimes you can use sentiment measures or some of these pieces. If you watch it closely enough, you can kind of see that sometimes it's either someone taking a position or maybe painting the tape to dissuade people from, or dissuade the public from owning an asset or trying to quell prices or use moral suasion. So I just thought I'd mention that.
Bob, we had another question come in here from Patrick. What is your opinion of the Texas Gold Depository? It's a depository by a sovereign state. So does that afford it any other protection on top of any other, let's say, vault within the U.S.? I know we kind of touched on this earlier.
Yeah, and it's a good question. Texas, and not only that, to be honest with you, from what I read, the last article that came out, this depository has been an absolute liquidity drain for the state of Texas. They were hoping that the depository would take off. I think it was I forget the gentleman's name that promoted the idea or talked about how they wanted to move the gold out of New York, and he ran one of the Texas A&M, I think, endowment or something like that. Well, it turned out they put the operation or the depository into operation, spent a lot of money doing it. And then he ended up selling the entire position out that they had in gold, I think about a year and a half ago or something like that, right before it went into operation. So it never really, they never got that $1 billion that was supposed to go into that. But if you look at the contract, if you believe in the Texas government and you're comfortable with that, more power to you. But if you read the contract closely, there is that, like I talked about earlier, there's an immunity clause that's built into that if something does happen and your metal is non-existent anymore or they can't perform to the contract, they are immune from any type of liability. And that's something to be worried about. Obviously, anywhere you store metal on a professional level, you definitely have to do due diligence on the facility, the operators, the structure of the program. If you go on our website, my website, goldsilvervault.com, under the media section, I did a whole did a whole sort of interview with a slide deck about the various risks to watch for when storing metals, especially in this day and age where there's a lot of retail dealers that have jumped into the fray of storage. A lot of them tend to use their own, they use like Branks, for example, and just set up a master account, and then they store the metal, charge a spread, but they are the ones that control that account, not the actual client. So you definitely want to understand the nuances of how these accounts are set up. And of course, then you get into allocated and segregated storage, and definitely knowing the differences between the two. Allocated is not segregated. It's not the safest way to store metals. Segregated really means that your metals are held separate and apart. So, those are the sort of the key words you want to look for in the contract. You see a lot of programs will advertise segregated, allocated in the same sentence, which is kind of hard to understand, but in reality, what happens is they have a master account somewhere. Their entire account is held separate from maybe another dealer's account in the same depository. But in essence, the client's metal is held on an allocated basis within that dealer's account, that master account. So they account for it basically on a accounting or spreadsheet basis. So, but that's, we could do almost a whole nother spaces call on how to choose and select storage depositories and programs and things like that.
Yeah, absolutely. And that's something that is, again, of utmost importance, that needs to be considered before you start storing, and to be able to understand what program you're choosing completely and understand the legal agreements that you're agreeing to as part of the terms of that contract. We had a couple of questions come in on Twitter. Jonathan Davis asked, was August 20th and March 22nd a double top? Either of you guys want to take that?
I'll let David take that.
Oh, thanks. I don't have my charts. I really don't know without looking, so I won't. If he saw it, it probably is true. A double top isn't too hard to determine, but I don't have anything I could pull up quick enough to verify it.
I think he's watching that sort of that cup and handle, the 2011 to 2020 top, that double top or cup, I guess you could say. And then you had this little handle that I guess maybe that's what he's referring to is that that pop back up off the Russian news, and sort of
okay, got it. Well, thanks for the clarification, Bob. Yeah, I do see that as a large cup and handle formation, but the only way you're supposed to trade that for a trade, not for investing, is it's got to break through the top of the cup. So if the top was, I don't know, what was it, 1970 or 2070, you actually wait for it to go above that, and then you put your long on. That's how that's supposed to work. But yeah, it has made that formation, and yes, I would call that a double top until proven otherwise. In other words, once what I just said takes place and it makes a new high and it stays there, then you've got pretty good assurance for going higher.
Perfect. Thanks, guys. David Lee Roth, you got a question?
Hello, hello, Tom. Can you hear me?
Yep, sounds good.
Hi, Tom, and hi, David, and everybody else. Just a quick hello from Australia. I'm just having my morning coffee. First of all, just thank you for all the work you do, Tom, and also David. I've listened to some amazing information from you over the past couple of years. I've been investing for quite some years now, but only really taken a deep dive the last couple of years, and especially my portfolio has gone completely over to commodities this last 2 years. So I've got physical silver and also silver juniors, gold explorers, gold miners, etc. One of the things I wanted to ask David, it might sound like a bit of a stupid question, but is this the craziest time he's ever known in world markets? Would he describe it as the craziest time? And does he think the computerization over the last sort of decade and algorithms has affected how things are moving and the way things are going?
Wow, what a question. Yeah, I would say that this is the craziest of crazy cubed. I mean, as Bob, I don't know who's been on here this whole time. I joined late, but the idea of the CDO squared, the movie The Big Short, and making a bet on a bet on a bet on a bet. I mean, it's bizarre. I am conservative by nature. I just feel that, that there is limited resources. People argue differently, and that we should take care of what we have, cherish what we have, and just live within our means.
Yeah.
I was taught by my betters, the kind of people that I follow that are mavericks of the economic sphere, like von Mises as an example, but others, that back in the 80s and 90s, these type of thinkers were saying that the stock market was nothing more than a large speculative casino. Mm-hmm. And that was when the only thing we had that was super leveraged was options. Now we have ETFs that have triple times the standard movement as an ETF. I mean, it's beyond a large speculative casino. It's, the overused, and I don't even like to say it, but the overused, it's a speculative casino on steroids with a CDO squared with a twist of lime. I mean, it's beyond belief of how distorted these markets are. Yeah. And anytime you get that far away from the mean, that far away from what I'll call common sense, I don't know how Happy would refer to it, but from the base level of reality. Mm. And yes, a lot has to do with algorithms, and a lot has to do with AI. And I just won't dwell on that for another minute or two since you asked the question. The algorithms are great when they work, but they're not so great when they don't. And this is where I've said it many times. You may have heard me if you follow me closely, that the public broadcasting system, PBS, did a documentary on the $1 trillion bet. And that documentary is all about long-term capital management. These people that are what I call econometrics, these are guys that get fawned over all the time. I won't name names, but you may know who I'm referring to, that talk about they got the secret sauce, the magic formula, the best computer, and all this stuff that quantifies everything into some kind of a math model. can look like geniuses for a long time. But in this $1 trillion bet documentary, nothing did better than long-term capital management. And everybody on Wall Street, I mean Wall Street, was waiting and lining up to borrow money to buy more shares of long-term capital management until it failed. Because human behavior can be predicted until it can't be. And there's enough randomness in humans that it can be not be predicted 100% of the time. It's like the Lincoln saying, fool some of the people, some of the time, all the people, some of the time, but you can't fool all the people all the time. And that's the human element. And because of that fact, the more distorted we get out into this unbelievable hyperbole system of make-believe finance, the worse the crash is going to be. And that's what's worried me from the time I started thinking about this, and concerned me even more. The first article I wrote for the public domain when I started in the web, as a public figure in 1999. And this is got me more concerned than ever because the distortions keep getting better and better. And then we have the authority figures, the political / banking class, telling us they're going to tighten, they're going to quit the taper, and they're going to, quantitative tightening. Are you kidding? That's like putting a Band-Aid on a skull fracture that you're, pouring out blood. I mean, it's not going to do any good at this point. It's beyond the system healing. There's no way for the system to heal at this point in time, in my view. Could I be wrong? Possibly. And I hope I am, but I really, really doubt it. Things are so distorted. So yeah, it's a great question. It's because of the AI, it's because of the algorithms, it's because we've lost our ability to think like with any common sense whatsoever in almost any realm. But the financial markets are the extreme because unfortunately in the Western Hemisphere particularly, everything revolves around money, and it shouldn't really, but it does.
Yeah. Oh, thanks, David. That's amazing.
And thanks, David, for the question and the kind feedback there.
Thank you,
David. To your point, when predicting the let's say the behavior of humans, we had a question come in that's kind of along those lines. It said a lot of people are talking about rotating into gold when the gold to silver ratio drops. What makes David Morgan think that gold will be available if everybody is rotating together?
Well, that's what the markets are really about. In other words, everybody that's at the Sotheby's auction bidding on the Rembrandt, there's only one of them, and it's the last one that bids the highest that gets it. So if the swap was a huge demand of lots of silver coming in to swap for gold, it would change the ratio. And, it would be settled. In a perfect market, it would be settled. But no, the point's well taken. I mean, if you look at the number I gave you, which is accurate, in April of 2011 of the 33-1, take a look at the chart. It wasn't there very long. It was a spike. So point well taken. And the other part of it really is the psychology. I mean, maybe, just maybe, at that 33-1 ratio, it drops from there to 16-1 because enough people are using it as a means of final payment, or that's the preferred means of payment for food or for transportation or for energy or something else. So we don't know the future. I think you should own both. They do have different functions. Silver is really more of a monetary metal than gold for the people. And of course, it's dissed by the banking establishment. The reason the bankers went to the gold-only standard is pretty well documented in the Wizard of Oz book. It's a whole metaphor for the Eastern establishment paving the yellow brick road to their ability to control everything. When you only have to control one thing, you have a lot of power. When you have to control 10 things, it takes more energy and there's more variables. So it's not as easy to control. When you say gold and only gold is money, it's a lot easier to get a handle on it.
Mm-hmm. Well put there. Nobody special. Thanks for joining, man. Did you have a question?
Yeah, thank you. I've seen quite a lot of noise in base metals recently. We had the fiasco with nickel that happened last week or 2 weeks ago. And then this week, there was a couple more stories. Yesterday, the news broke that Trafigura was pulling, I think it was 50,000 tons of zinc out of LME warehouses in Asia. And then Goldman Sachs releases a note yesterday saying that copper, I think the words they used was, it was sleepwalking into a stock out, meaning inventories are dropping so rapidly, the price isn't moving. And they're basically warning kind of everything we've been hoping to see in gold and silver for the last few years is about to happen in all of these base metals at the LME. Do you guys see any kind of a dotted line in market mechanics? I know the LME is not the COMEX, but do you see any chance of a spillover effect in the base metals affecting gold and silver eventually?
Possibly. I'd have to think about that. I'm a bit of a deep thinker, as you may know. What I do believe strongly is that, the money of last resort is gold and silver. The run to money is what everyone will be concerned with at some point. There's a very narrow doorway to get to it, and it will be tighter and tighter as more and more people try to rush through that small opening. Will the base metals affect it or not? I would say more likely they would than they wouldn't, but I don't think there's a direct correlation. We actually had a zinc mine that we put on the Morgan report that was just a gift. We knew that baby was going to do well. It had huge silver credits, and most people didn't know it. And Chris Marchese, that was one of my analysts at the time, pointed out to me that we're coming into a zinc shortage. This was a few years back. So a lot of these base metals are tighter supplied than most people think. The problem is, in an economic contraction, which we're now witnessing, not everybody's going to be driving an electric car in 2030. You could quote me on that.
Why not, David? Not everybody has $60,000 and the available metals to be able to dump into these things right away. I mean, the green revolution's right around the corner. I thought, isn't that what we've been promised?
Exactly.
Yeah, hey, looking for some platinum group metals exposure and not trying to get out of the South Africa risk. Take some profits from Sibanye. Any thoughts?
Zach, I don't think I heard that all, but I'm pretty favorable to platinum right now. I sold most of my palladium, but I think platinum couldn't go much lower. I like it as a low risk entry point. What I don't know is how long you'd have to hold on to it, but there's several factors that line up to make platinum a pretty savvy buy at this point.
Looking for companies that are currently producing, even as a secondary.
Yeah, sorry. Yeah, I didn't hear your question. I'm sorry. Yeah, that would be one. The old Stillwater mine. That's probably a good one. I'm not too favorable to anything in South Africa directly this time because of the geopolitical situations.
Yeah, lots of juniors in Canada, but nothing producing really, right? It's hard to, not too many that.
For me, I'm not a big ETF guy, but I think an ETF is probably safer. But you could do the one mine you mentioned. That's probably a fair game. It's a good one.
We had another question from Tyler that was submitted via Twitter. Is it possible gold outperforms silver if countries readopt gold money? Seems, quote unquote, good jurisdiction, gold companies might be most desirable as opposed to Mexican/Peruvian silver miners.
Yeah, I wouldn't rule it out. I think he makes a case for that. Obviously, we talked about the gold-silver ratio. Silver's, I did a lecture series for 1 year, and I only did that speech about 3 times. It's on my website somewhere. And I said, what if silver were treated like gold? And I go through the whole dissertation on when silver was money and gold was money, this is how they performed. And since silver has been kicked out of the monetary sphere by the money masters, the monetary elite, the banksters, since it's no longer considered money by them, then it has less value. But think of the reverse. Think if they used silver as a monetary reserve, and if they had to put it in a ratio of 10 to 1, like it comes out of the ground right now. It's really more like 7 to 1. Think of how much of a monetary demand there'd be for silver. It'd be unbelievable and probably sell for more than the price of gold. But of course, it's not considered a monetary reserve anymore. But remember, we were on the silver standard up until 1900. Yeah, I know we're in 2022. I know I'm talking 122 years ago. But if you didn't have silver, you had no money. So if everybody that's worried about their bailing in bank account digital currency in whatever country you're in, and you look at that as your safety net, your nest egg, your way you pay your bills, that is the way we do it in today's world. But if you go back 122 years, if you didn't have silver, you had zero. You had no money. So will it resurrect as in the monetary sphere again? I doubt it. Officially. Unofficially, I'm pretty certain it will. But to what level? We don't know. So if it's always in a cognitive map where you are taught to think that it's only an industrial metal, then I think the case you make is valid.
Awesome. Thanks, David. Timas Goemar had emailed me this question. In portfolio theory, the unit of measurement for us is the dollar, but the dollar is a variable unit of measurement. The so-called experts say that you can diversify away from the dollar, and while this is true, statistically it does not hold up in Exeter's inverted pyramid where gold is the only true form of money. Everything else is paper and its derivatives. For this reason, everything should be measured in ounces or grams of gold only. Therefore, we must compensate for this anomaly, or rather correct portfolio theory, don't you think?
Well, that was a well thought out question. Yeah, I would say that's true, but I have to add in theory, and well stated, by the way. We need to be honest. Look, my mission statement is to teach and empower people to understand the benefits of an honest financial system. When an ounce of gold is an ounce of gold, or an ounce of silver is an ounce of silver, is there anything magic about them? Maybe yes, maybe no, but they're honest. It's honest weights and measures. We know what we're getting. There's no disparity. There's no derivative. There's reality to it. And because of that reality, we all could get along in that realm. And, you know, I've made up the saying that when you can lie about money, you can lie about anything. So, yeah, I think you could price it in those terms, but you could also make the argument you could price it in silver or, you know, some other commodity. But, you know, God's money. I mean, people have voted through thousands of years what they cherish as money. And yes, it's been tally sticks, and yes, it's been seashells, and yes, it's been salt, and yes, it's been cowhides, but it's been gold and silver. That's what the vote is. The vote is overwhelming that gold and silver are considered money by the populations, no matter what part of the planet they're on. And I think that we'll come back and taste that again before too long.
Yeah, it's interesting. That was he had sent me that question a little while ago, and I said that maybe if that's the way that you want to think about it, maybe you should be measuring your wealth based in ounces, acres, productive, tangible assets, things like that, and you know, look at you know, evaluating your wealth in that way rather than in dollars, if that's not what you want to use. Because again, I've made this point many times on the show that this is you know, we measure gold versus the dollar, we measure silver versus the dollar, we measure every other commodity, we measure other currencies even versus the dollar. This is all a moving measurement, a moving yardstick by which we're comparing everything else. And if you want something, I guess, that's more stable than that, then you have to use a different measuring tool, right?
Yeah, one thing I would probably mention that we haven't seen in this market, that at least with silver, and this could actually kind of change silver a little bit, the dynamics of it. And I talked about it earlier, was this sort of idea of a national exchange where you have a lot more transparency in the pricing of silver itself, which would bring more people into the market, knowing that if it's easy to buy and easy to sell, and there's structure and organization around it, that would be I think a game changer. The problem we have in this current environment with this dealer market or dealer system, I think it tends to put a handicap on buying silver as an investment for some people because of the premium structure. that might be something that I know David and I talk about a lot, but just having it. The one thing about Bitcoin that makes Bitcoin kind of unique is that it doesn't cost you a 40% premium to buy it versus a Silver Eagle. So the industry needs to step up, I think, if it really wants to see this market kind of come alive. It needs to have a more balanced pricing structure, or you do have bottlenecks, obviously, with blank production and that type of thing, but there just needs to be a better way of trying to create a more two-way market. So, like I talked about it earlier, if you actually have, Silver Eagles are valued at $15 over spot, but you could sell it on an exchange at $13 over spot, and you have a $2 spread. Doesn't matter if you're buying a product, at $5 over or $15 over, if there's always a $2 spread to it or something of that nature. I think that would give a lot of confidence to the market, but that's just a thought.
Does anybody else have any questions that's on the call? Just a reminder to put your hand up if you do. Well, we have been going for about 4.5 hours, Bob and I. Happy to continue the call, but if there's nothing else, I think this was a really good way to be able to interact and answer questions and see what's on your guys' minds.
Yeah, I think my phone is probably more exhausted than I am.
That's a good way to put it. I had to plug mine in about 3.5 hours in here. So, Agency Asia magazine, did you have a question? Just trying to get through add some speakers back in here so that we can see if you guys do have questions.
One thing that maybe if anybody does have any comments or anything like that, which I always look forward to, if there's anything they'd like to see, maybe me try to do some research on or try to put that out there on Twitter, feel free to, DM me, or if you want to put it out as a tweet or something of that nature, I'll definitely take a look at it. Because at the end of the day, I think, David does a great job with this about, teaching and trying to be, just try to be more educational out there, not try to create, the speculative type of drama that you tend to see with some promoters and things like that. To me, trying to give you balanced information more from the industry's perspective, as well as, not only that from the physical world. That's where I try to come at it from. I think hopefully it helps people kind of understand that the COMEX isn't this shady organization, even though, yes, some of the pricing structure and the spoofing that goes on is definitely totally illegal. But the COMEX by design is just, it's a market, and it serves a purpose. It just happens to serve a purpose for hedgers versus the purpose of price discovery. But hopefully this kind of helps.
Yeah, absolutely, Bob. And I always definitely appreciate having your input on these things. And to your point about anybody having suggestions about topics they want covered in the future, let either of us know, and we're happy to try to address those. We had Joel ask, with the near-term likelihood of Fed QT and rising rates, I'm hesitant to buy PMs. Am I wrong?
Yeah, I would say so. I mean, first of all, it depends where he's at. If he already has them, then, you just need some. You don't need to go all in. If you have none, the argument's valid, but I think it's inaccurate because, again, the run to gold is an emotional run. It's not a well-thought logic. What's interest rates going to do? Can the Fed first of all, the Fed can't get this thing under control. There's no way. The cat's out of the bag, as they speak. Pandora's box has been opened. You just look at the gas prices, look at food prices. Are they going to come down? Yeah, they may, but not by much. and the uncertainty factor keeps accelerating. So I would say if you don't have any metal, buy it. If you've already got some and you feel it's going to be lower, and there's a war premium in gold. I'm not sure there's a war premium in silver right now. So if something on that front happens that's quote unquote good, you might see gold sell off. Silver, probably not.
Zach, you had a question
this
again?
This is a new forum for you. And yeah, no, this is like a new forum for you, right? And I think the speakers here would be an amazing start. And like this kind of community, we should really find a way to get direct to miners. And like I know First Majestic, I saw it on Twitter, had like through Sprott, their 5-ounce bars or whatever. Like, you know, people like, I know there's like the Silverback, the community, they're great pulling COMEX bars, right? But you know what? I think you got to cut these banks out, and these kind of communities are the way we're going to do it for sure. We should work together in that sense, and love what you guys are doing. Thanks.
Not a problem, Zach. And you know, I think as part of your comment, the banks do serve certain purposes, right? Like Bob, you can speak more to this, but the ability to hedge is a legitimate purpose of that market, right?
Yeah,
they can hedge to me, and I'll pay up front and send it when it's ready.
Yeah, I think with the market wouldn't be as dynamic and as liquid without the ability to hedge. I think that's a very fair assumption that allows dealers and allows on the monetary side, the ability to take inventory, hold on to inventory, and not get caught up in just the simple price volatility. One of the things that I looked at, because I run a hedge fund as well, or I run a hedge fund, and one of the things I've looked at is, and kind of asked the question like of the miners, so to speak. You know, like for example, you know, what's to stop someone like me creating an offtake type of agreement with a miner where I can buy silver from them at a discount, have it made into product, and sell it at spot for the market? Versus, you know, what First Majestic's doing is some of their premiums are extraordinarily high. You know, if they're just selling production, their production may be, you know, well below market when they bring it out of the ground, and their total overall cost. The question is, if you really want to try and create a competition of metal, I guess, there has to be almost disruption in the current model, and that's one of the things that I always look for. And I've brought this up to numerous industry members, you know, like I mentioned earlier in the past, and it's a very difficult thing to bring up because everybody wants to protect their profits, and that's, I think, where we're kind of stuck in the metals world right now. Is the premiums are so high. It's, you know, without that more transparent market where people know that they can actually sell this stuff well above spot, it makes it really difficult to get the public really juvenated to buy metal at $10 over spot. So that, I mean, I kind of look at all this kind of stuff, you know, and it's probably a great question for the mining industry. You know, the ability to say, at what point does profits overtake maybe honest money, so to speak? And you know, I would definitely be willing to look at that type of opportunity that would maybe allow where people can buy metal at much cheaper levels if they want to try and really compare it to the spot price or to the COMEX price, and you know, where people can start buying and feeling like they're buying at spot like they do Bitcoin, and they don't have this magnificent markup they're trying to work through.
All right. Any more questions from anybody?
I would say, like you're saying, is the premiums are so high. One day, will there not be a spot price is the spot price of an ounce in my hand, and then your paper, obviously, it serves a purpose, but like one day that has to break, right?
Yeah, I think like to David's point, the like we were talking earlier, that the problem is you could have basically the paper price go crashing downward, or just kind of go no bid in a way, and or the opposite happen in the physical world, where, for example, anybody who's hedging using calls to hedge a short position, and the price goes up exponentially, and then they have to exercise those calls and buy, let's say futures contracts, or take delivery of metal, whatever it may be. The enormous capital to convert those calls into the underlying asset. That's the kind of stuff that I think will ultimately move the market higher. It may not be, typically like in 2011. That was, I think, Jeff Christian did a great job of kind of explaining that it was the contract roll that kind of created that elevated straight move up and squeezing shorts and hitting the buy stops and that type of thing. And I think, that David, of course, could probably mention the 1980 market a little bit, but I think that's what we're going to end up seeing, is maybe some sort of unwinding of some of these products and some of these hedges. And that's one of the reasons why, when you're looking at mining companies, if these guys are hedged, I mean, you look at Barrick Gold back in the mid 2000s, they ended up losing, I think, $3 billion on their hedge book as the price kept going higher and higher. So you could have this scenario like LME in the mining group, but it may not be. You may be the unlucky winner of that mining stock that you thought was going to go up when gold goes up, but they may have been, fully hedged that entire production. I mean, you just don't know. That's why it's, professionals like David are great to follow, because they do all that kind of work.
All right, Bob, that was well put. We had a lot of excellent questions come in and a lot of great interactions. And I think that this was a good way to be able to actually, like we said, interact with all of you guys and really get a better idea of what you want to know and what's on your minds. If there's no other questions, I think we can kind of wrap up here. Bob, do you have any kind of final thoughts here before we do?
I think this forum is a great way. I hope everyone kind of sorry about that. We got a dog in the background, but I hope this forum was a great way to maybe start a new type of dialogue, where people can kind of get more maybe access to information, ask questions, that type of thing. Not to take away from the subscriptions of and other types of advisors, services, and things like that, but I think it just helps bring people more in tune with the markets. It allows for debate, allows for interaction. I think it's the way to go. It's just the question is, can your phone last as long as these tools do?
Yeah, absolutely. And you warned me before the call that I had to have a charger handy, and that was a great suggestion. Because you and I have been on here for almost 5 hours now. But yeah, it's great to be able to kind of dissect these questions a little bit more and get multiple takes on every aspect of what people want to know, right?
Yeah, I think one of the things I've learned in doing these calls is there's a lot of smart people out there, that may have a couple hundred followers, and we get caught in this trap of you need to follow the guy that has 100,000 followers because he knows everything, and it just seems like there's just so much out there with Twitter, I think, and there's a lot of bright people bringing these people together. I would never have found a lot of these people. I mean, it's a great way to interact, and hopefully we can do more of these. Because I've been looking at some type of forum, whether it's interviews or 2 or 3 minute type quick videos on YouTube. But I think this is a great way to try to. You definitely go to different topics very quickly. You can kind of cover macro. You can cover the monetary side. You can cover the stock market. I mean, you can get a lot of different flavor So hopefully this is just the start of something.
Yeah, absolutely, and I'm happy to do a lot more of these, and we just have to. I guess it's just a matter of making sure we spread the word to get a good amount of people exposed to this information, and then I can ask some more guests that I've had on the show to help answer some of those questions that everybody has.
Hey, Bob, I know you said you wanted questions on stuff to follow or stuff for you to research. Is if since the Russia announcing the ruble for 5,000 and whatnot, if there's any change that you can find in in voltage or where storage or where metals are flowing, that would be cool to see if you notice any changes there. And look forward to doing this again.
Yeah. It's interesting because and I think this has been touched upon by a number of different experts out there. The way the market is moving and has been moving, there's been the exchange volumes have been dropping. The banking activity has been definitely diminished. There's metal that's going to strong hands that's not showing up in a lot of these reports, and people are trying to figure out, like for example, I think Bloomberg had an article a couple months ago where there was a buyer that was under $1,800 an ounce that was just buying whatever came to them. There's talk that there's now a buyer under $1,900 an ounce that's sitting there on the bid. This is the kind of stuff that you try to at least get a feel for the color of the market, or the dynamic that, we may not see, open interest or your traditional put call measures and sentiment numbers, that type of thing show what actually the real underlying strength of the market is. And that's where I that's what I've kind of developed very good relationships in the industry for, was dealing more with the institutional level, where you can kind of get a feel for, who's buying. Is it the retail crowd, a lot of small orders, just a large amount of orders, but small amount of transactions or transaction value, or is it, smaller tickets and bigger transaction value? That, I think that adds a little bit more appeal. And that's what I try to show, at least when I put out these EFP numbers. And, I try to show that, if there is stress there, to be kind of aware of it. That's all.
And Zach, I don't. It's a little off topic, or maybe asking in reverse. Russia put out a statement that all their gold is on their soil, and I thought it was an interesting statement for them to make. Now, you can take that any way you want. I'll tell you what I think it says. As I've stated 4 times already about the run to gold, when Venezuela wants its gold back and it's at the LBMA and the LBMA says no, then who's the true owner? When some other country asks for their gold back that's at the Fed and the Fed says no, then who really owns it? So Russia was saying that all Russian gold is on Russian soil. So there was a bit of a hint there, as far as my thinking is, that just because you think you own it or you have it on paper doesn't necessarily mean that you are going to get it back or that you truly own it. So things are going to unravel in a very unyielding manner, where a lot of things that people take for granted, even in the precious metals world, are going to have a great big wake-up call. And unfortunately, it'll probably be a lot of the big boys too. The people that are just, we call the silver stackers, the gold stackers, you should be fine as long as you do what we teach. Maybe if you got a stack, you want to go in the paper markets or ETFs or whatever, that's fine, as long as you've got a secure position in the physical metal. But I think as this thing unravels, you're going to see a lot more. I mean, what we've already talked about, where Barrick was over-hedged. I think a year is the most you should hedge, but I wasn't a CFO for Barrick. The point being is that even the big boys can make some really, really big mistakes. And when people really want to reclaim or touch or put into their premises what they've already bought and paid for, being a bank or hedge fund or a sovereign wealth fund or a family office or any of those things, and they find out that it's more cumbersome to get it than they ever expected, or they're going to get a paper equivalent, things are going to unravel rather quickly. And I see some of that taking place.
Zach, I don't know if you were here for that as well, but we were kind of talking about that earlier, that the 5,000 ruble per gram announcement that Russia had made was only for their domestic producers and the kind of the bullion banks that deal with those domestic producers. So really, while it seemed like maybe they put a floor under the price of gold, it was only inside Russia really that was that applied to.
But my whole thing is there's lots of countries in Europe, and maybe there's some of them positioning to start to pay in gold. Maybe there's ones pulling their gold back. Why? I think Australia is looking to say, hey, England, what's up? And the other thing with Bob, I wanted to, like he said, these communities, and these are things where, like you say, somebody's sitting on the bid. Somebody like Bob who has vaulting and who has these means. Maybe you get 5 guys. That's guys willing to take delivery on an ounce or even vault on a 1,000-ounce bar of silver, and like you said, just sit on the bid. The guys, listen, okay, we'll lock in at this price, and we're ready to take it at that price anytime. I bet you there's guys out there willing to go.
Yeah, absolutely. And I think as I would say as the market develops, we're going to see more and more of that.
One thing I would say, I think the market underestimates how easy it really is to start taking delivery of this stuff, and create disruption. Not necessarily disruption from a market manipulation standpoint, but disruption from a standpoint of saying, hey, listen, silver is like 50% below its 1980 highs. It's definitely not caught up with inflation. It's you like I did on my presentation at the Silver Symposium. I mean, silver itself, it's up 1,400% since 1971. Gold's up 4,400%. S&P 500's up 4,400% or so. I mean, there's a lot of catch up that could be with silver. It's an interesting metal from that perspective, from a relative valuation standpoint. So even if you're like a hunt 2.0, so to speak. I know some people say that on Twitter. You're buying it with an idea that, hey, this is if we're truly going through an inflationary time period, there is actually a lot of value here that could be uncovered. And I think that's what attracts a lot of us into the silver market when they look at the relative valuation. It just and it's interesting because everything is at the margin. Yes, there could be 1 billion ounces of sitting over in London, but you know what? It takes a month to get those ounces out of that facility and on a boat and sent over to New York. If New York's starting to see, bleeding at the COMEX, so to speak. So there is time delay there that, you can hedge it by price, on paper, the activity, and of course you could pay someone off and cash settle them at a lot higher price. But if the idea is truly to start taking delivery, you're right. All it takes is a couple of billionaires, so to speak, and just start buying. With the idea that they just take it and put it in a private vault somewhere and outside the COMEX system, and all of a sudden you have a deleveraging that starts to unfold in those markets.
Anybody else have any questions? All right, Bob. Should we wrap this up?
Yeah, definitely. If you want, give it call it a night. I guess I think it's important that, I think you recorded this whole thing, so I guess not something that you probably will be able to email out, but definitely you could have it where people could replay it. I think this is a great opportunity. Again, I appreciate everyone who came on to the program and participated, that type of thing. I mean, if it wasn't for the followers and people that had true interest in the topics and so forth, that makes it worthwhile for me. Just trying to educate people, trying to get them inspired. It's for the reasons why I offer very low premiums when I put those premiums out I hate to see people overpay for product that, just because someone's saying that it's there's a shortage out there when it's just simply a time delay. Those are the things that I try to just bring to the public's awareness. That way they feel like there's the game's a little bit more more of a level playing field.
Yeah, that's
one
well
little
put, Bob.
thing to look going ahead is maybe you do these often and do them short. That way, you people like David and Bob don't get and you as well don't get your time wasted with the same questions, right? If it's too long, you get too many repeats, right?
Yeah, I think it's going to take time to kind of calibrate to the types of questions that we're getting. I mean, we got a couple repeats tonight, but nothing too crazy, and I think everybody got a lot of good value out of this. I mean, the reason I put my email up on Twitter and everywhere I can is because I want to know what you guys want covered, and that's what makes this show I think valuable for a lot of people, is that I try to pay attention to that and to continue that dialogue with everybody. I've never once claimed that I'm the expert in any of this stuff. And I am absolutely unbelievably grateful to Bob, especially David, all my guests. But, Bob has spent countless hours with me on the phone, explaining things to me, in some ways calling me out on stuff, always being willing to help. And I really, really appreciate that, Bob. And you have taught me so much in this space, and I honestly, I can't thank you enough.
Tom, I just landed. I'm wondering is there a way to give just 5 summary bullet points, if there are 5 general takeaways for those of us that just joined?
I think David could probably start with his price expectation, where silver's going to be in a week from now.
Which direction? What's your opinion, huh?
Yeah. I think on the bullet point side, I kind of went through the industry. I think how the industry views premiums. I think the broken structure of the retail product, so to speak. How the Trump 2017 tax plan actually killed. In a way, it killed the equalization of premiums, because typically what used to happen is if premiums on 1 ounce product got really, really high, you would sell that premium or sell that product and buy 1,000 ounce bar or 100 ounce bar, whatever it may be, and you capture more ounces. That's traditionally what people used to do. But with the precious metals not being part of that 1031 exchange program anymore, that's just simply a sell and a buy. So it's a taxable event at that point. Those are the types of things that I've tried to kind of share with people. It's not necessarily, yes, it's a production issue, it's a blank issue, it's delay in delivery, but I see a lot of dealers, promoting this shortage idea or this, massive short position in a certain area of the market. And it's easy to speculate. The one thing I didn't touch upon, which I think I talk to clients a lot about this and people that call up. When you look at a lot of online broker dealers or a lot of gold dealers out there, a lot of people have been noticing that the spot price that they advertise is totally different than what the actual spot price is. And more people are starting to notice this. And I brought this up in the past, but I think it's another reason why, and I kind of mentioned it on Twitter, is check out your local dealer. There's the industry is doing things that I don't think is in its best interest, and I worry that it'll sort of tinge the the consumer or the investor's attitude toward physical metal. But these are things I just try to bring up because I want people to kind of understand, do your due diligence, research. It's buyer beware out there. I mean, that's the kind of environment we are in the physical metals world because there's no regulation or compliance. So not to bang on gold dealers, they definitely serve a purpose. They're allowed, they certainly should make money. It's all part of capitalism, but be transparent. I mean, I come from a world of stocks and bonds, being in the business since 1992. So I live in that compliance world. So if the spot price is the spot price, I base it on what my wholesaler is selling to me at, not what my wholesaler is selling to me. And then I want to mark it up another 20 or 30 cents an ounce. I mean, that's just not, it's not a correct thing to do in my opinion. So, but yeah, I think, those were some of the topics covered. I know we kind of went into other things. David definitely covered a lot more on the philosophical side.
And kind of interestingly, to your point there, Bob, you and I were speaking maybe about 2 or 3 weeks ago, and exactly what you were saying, that the spot price on the website that I had seen, the particular website that I had seen that morning was, their advertised spot price was something like $40 an ounce higher than the current spot price on my phone. So, that doesn't include the premium that you're paying for whatever coin that you're going after, anything like that at that point. So there are weird little tricks like that once you start paying attention to, that I can totally see why that scares some investors away from this space and can make some people disillusioned from the idea that gold and silver is supposed to be really a great way to, preserve the value of some of your labor that you've traded it for, right?
Yeah, that's one of the reasons why I said the silver squeeze movement was really all about squeezing the consumer, not the price, not the physical ounces off the exchange or into people's hands. I mean, it really was a bonanza on the premium side, and again, not to disparage the industry, but there should be some form of self-police almost that allows, that tries to stifle these practices. It's to me, it's not going to be a confidence booster. It's going to, I think, sort of, it just adds to the cost of the product to the client. And so when I say 265 over spot for 100-ounce bars, and another dealer says, hey, I can match that, but then they jump the premium up on silver by 30 cents an ounce. It's not comparing apples to apples. And it just gives the industry a bad image. We've already fought through a lot of these the last 2 years, a lot of these programs that have overcharged, gone after senior citizens and retired people that, 50 to 100% premiums on bullion products when they, these 1 1/4 ounce or 2.5 ounce oddity products that the Royal Canadian Mint puts out, or these Australian mints and that type of thing, that's scooped up by these retail sort of telemarketers, so to speak. It doesn't create that good image, and that's what I'm trying to promote, is something that's going to give more longevity to the industry, because I think the next few years is going to be a big winner for the metals, and it may be probably the best performing asset class going into the next 2, 3, 4 years. Just because it hasn't performed at all. I mean, it's been dead money for so long that with all these pressures building behind the market, when that pressure or that tsunami does release, it'll have devastating effects. And I think it's going to show up in confidence. And I think a lot of people say, well, if silver goes to $200 an ounce, it's not a big deal if I pay $15 over spot. That's my insurance policy. And I get that. I totally understand it. It's just that, for preserving purchasing power. I just don't see how you should give away most of your purchasing power, in a premium that's just overly marked up.
Yeah, well put, Bob.
You could think of this as a Jerry Lewis telethon.
Except we don't have a whole bunch of applause from everybody.
Well, I appreciate it, Tom, and you guys always do good work. I just landed actually from the Bitcoin conference in Miami, so I just wanted to just jumped on the Twitter Spaces to see what you guys were talking about. I only caught the last 5 minutes, but I'll catch it on your website. Thank you.
Awesome. Thank you. Zach, do you have anything to add?
Yeah, one last thing for Bob. Maybe it's another thing that we always talk about the ask spread is people who have metals in storage with you should almost be like you should almost be reaching out to those end users now and say, hey, listen, I know we're not there yet, but when the day comes, people with real bars sitting there can maybe say, okay, at 50% over spot, you can snap your finger and send it to Sony or send it to Tesla, right? And instead of always getting hit premiums both ways, we should people being safe and ready. We should hopefully try to get away where we're not getting hit so hard on the premiums.
Yeah, I agree. And that's one of the reasons why I try to find the lowest premium products out there and promote those, because I worry about premium decay. Like I mentioned earlier, when silver hits $60 an ounce or $50 an ounce, you're going to see selling. There's a lot of overhead. There's a lot of silver that was bought in 2011, 12, 13, that was bought above $30 an ounce. And that's just waiting to come into the market. And to basically tell, to promote the idea that you won't see that, I think is disingenuous. And of course, the industry doesn't want you to know that because, they won't be able to get away with these high premiums. So I don't mind being sort of the odd guy out, but at least trying to promote a little bit of, just a little bit more certainty out there or honesty of, what could happen? Because my model is always looking at risk first. You assess the risk before making your decision. But yeah, it definitely. One nice thing is clients that have metals here. I mean, client sells $100,000 in metal, we can wire fund same day. I mean, that's just the nature of what I do. I do what basically these digital products do, but I just do it on a manual basis where it's still over the phone. It's a little bit old school, but to me, it's more secure. So
I was thinking more along the platinum group metals where, you can have metals actually sitting on the asks nice and high and actually take advantage of these squeezes and whatnot. But yeah, I know what you mean. Less so silver, but you know what I'm talking about. Thanks.
Yeah. Well, I appreciate it. Yep.
Bob, maybe something worth going over here. I know you and I have talked about it before, but how do you ensure that there's enough liquidity in your system, or however you want to put that, to the point that if you had a big demand for people trying to sell out of your vault, sell their metal back to you, how do you ensure that you have enough liquidity to be able to cash those people out?
Yeah, that's actually a really good question. And my business model was more designed around high net worth individuals. So our transaction sizes tend to be much bigger than the most normal retail dealers. But one of the reasons why I work directly with the wholesalers, and then within the wholesalers, I work with wholesalers that are supported by or have very, very good relationships with refiners and other fabricators, because ultimately what's going to happen, because I get this question a lot, what happens when silver goes to $80 an ounce or $100 an ounce or whatever that magic number is, and everybody starts calling up wanting to sell? It's going to be a nightmare. The retail dealers are not going to have the balance sheet to basically take in all the metal that they've sold. They're going to have to rely on the wholesalers. The wholesalers are going to be hedging their everything they're buying they're going to be trying to dump it onto the refiners, or if it's or trying to refine the product themselves or melt it in 1,000-ounce bars to take it onto the exchange. You got to have an exit strategy, and that's one of the reasons why I have the relationships I have with some very, very good institutional players that can move a lot of metal if need be. They have the capital, they have the bank structures in place, or they have the two-way type of clientele base that will want to take the metal in. So that's important to understand. And I think it's very, the exit strategy is something not a lot of people think of. And like I mentioned earlier, if you look at Singapore, for example, which we store in Singapore as well as here in the U.S., but Singapore was hit very hard with COVID and the lockdowns, and you didn't have a lot of activity there. And so there's programs there that the bid structure, if you want to sell your metal back, is very, very poor. It's a very weak bid that you're getting. I mean, in some instances, you're talking $1 to $1.80 below spot for a 100-ounce silver bar. And so that's why you want to understand the ramifications of where you store it. This foreign storage idea, it sounds great on paper, but you really got to, if you're sending your metal to a location that's somewhat isolated, you're going to have isolated liquidity. I mean, it's just the nature of the beast. Otherwise, to ship that metal back to the States, because the United States is still the most liquid place in the most liquid market in the world for precious metals. That's why we had a guy ask a question earlier about, where's the best place to store it, or, the U.S. isn't the greatest place in the world to store. In reality, the U.S. there's a lot of advantages here in the U.S. that you don't have elsewhere, and it's still a very deep market. So, just understanding all that, if you store your metals at home, have a good relationship either with the local dealer or try to make, try to work with, whether it's a big online dealer or someone like myself or a depository, ask around who they use, what kind of wholesalers do they have relationships with. I mean, those are the types of things you definitely want to ask a lot of questions well ahead of time, because when that wave comes, especially if you're trying to swap out of silver into gold, or maybe just trying to exit the position altogether, having that relationship in place ahead of time is critical.
Yeah, absolutely, Bob. And those are, again, just good things to think about ahead of time. And as always, this is something that we're doing to kind of prepare for a crazy type of event, right? Or ideally we never have to cash this stuff in, but you do want to be prepared and think of the eventualities of possibly liquidating it when the time comes, right?
Yeah, and not only that, I mean, just understanding, again, if it's not here or it's not in a professional facility or in the U.S., or if it's not, or if, let's just say you have a structured program, for example, the idea, we talk about, what happens when people start demanding physical, for example. If we get to that moment in time and let's say you have PSLV and you're thinking, okay, I can demand physical because I have 10,000 ounces. I can convert that into physical bars. Well, when you do that conversion or that redemption, that's a taxable event. And then you take delivery of the physical metal. I mean, there's costs to everything. And that's, there's obviously a lot more costs than just simply that, but you want to understand all the friction costs or carrying costs that you're going to run into. And that's partly why I try to talk about various programs out there, not to disparage them, just mainly to allow the client to really read the agreement, understand the structure, and what the overall costs are going to be wrapped around that program, whether it's dilution, whether it's extra service fees, transportation costs. I mean, like what happened in London in 2020 when everything shut down, trying to get metal to the U.S. was, everything was just, you couldn't fly anything anywhere. I mean, everything was just shut down. So, and Singapore is seeing the same problem right now. If you want to move metal out of Singapore, it is very expensive. I mean, you're talking what used to be 35 cents an ounce for silver to move out of Singapore to Singapore. It's as much as $2, $3, $4 an ounce now to move metal out of Singapore. Because to get the air cargo, there's a lot less planes flying and so forth, and cargo space is just a lot harder to come by. I mean, these are things you don't think about, but it's just the nature. It's the nature of the markets.
Yeah, I guess we can wrap it up for this evening. Bob, David, I really appreciate your guys' input and your time to share your expertise with our audience. Big thank you to Tom and Happy for their contributions as well earlier, and of course everybody that tuned in. It was excellent to be able to kind of chat with everybody and to see what's on your guys' mind and what you guys want to know. Any last words there, Bob or David?
No, again, I appreciate everybody coming on, participating, and hopefully this is a start of something, just a different way to look at the market, to understand the markets, interact with professionals. I love the interviews you do. It's wonderful to get all that type of different color and association with different ideas and so forth. But this is a cool forum to kind of be able to come together. And guys that I probably would never have met before, I definitely have had a definitely an admiration for now, and it's look forward to kind of following them on Twitter.
Mm-hmm. Yeah, and I appreciate again you for the suggestion of doing this. I think it was excellent to be able to chat with everyone and to answer some questions. And really to give everybody access to guys like you and David to really just be able to run stuff by you and see what you think about it.
Definitely. I appreciate it. Thank you very much.
Thank you, Bob. Thanks again for your time and all your expertise. David, do you want to finish up?
I'll just say thanks for inviting me. Thanks, Bob, and all the listeners. Hopefully of some value to all of you or some of you. And it was rather lengthy, but some excellent thinkers, some very smart people. And that's all. I'll leave it. I'll just sign up by saying thank you, everyone.
Thank you, David. It was excellent to have you, and I'm really glad that we were able to fit you in after your meeting there this afternoon. All right, guys, that wraps it up for this evening. I really appreciate everybody being a part of this. I think it was we can declare it pretty successful for the first time out, and we'll look forward to doing it again. Thanks, everybody, and have a great weekend.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.